We're at a really important, interesting, pivotal moment for natural gas and LNG markets. Last year, the world entered what some are calling the third wave of LNG, the largest expansion of LNG export capacity ever recorded. Not counting the LNG export capacity, which has already started operating in 2025, there's around 300 BCM a year of capacity that's taken FID, is going to presumably be starting to operate by the early 2030s. Global LNG trade was close to 600 BCM last year, so quite substantial. And maybe I could ask folks to put themselves on mute for the time being, because there's some background noise from some folks. Again, LNG being under construction doesn't mean it will actually arrive on the market in a timely manner, but still the scale is unprecedented, with the US and Qatar leading the surge, joined by new and growing supplies from Australia, Argentina, Senegal, Mauritania, Nigeria, Mozambique. And while the supply side of the story is becoming increasingly clear, the demand side is anything but. Where is this gas going to go? We saw in the WEO last year that the IEA devoted a lot of attention to what seems like a simple but complicated and consequential question, which is where all this LNG is going. Some consider that LNG demand is going to grow faster than anyone anticipates, not only in Asia, but even in Europe. We saw that in the current policy scenario in WEO. That was where most of that difference went, where in that scenario, global LNG demand increases by 260 BCM between 2024 and 2030. And the single fastest growing market over the next decade was the EU. Incremental LNG demand in Asia as a whole is higher, but the EU was the biggest increment. There are other views that consider there is simply too much LNG supply coming, and the result is going to be US LNG shut-ins, even more so in a case where US gas prices go higher than the $3 to $4 per million BTU range. And I think answering that question has really become more important, but also more difficult as uncertainty grows about economic conditions, the pace of the energy transition, fuel competition, particularly between gas and coal, and evolving policy choices in some of the key consuming regions. And at the same time, a dynamic and complicated geopolitical landscape underpins all of this, where the gas and LNG markets are becoming more fragmented, more politicized, which is part of a broader trend for how the rules-based economic order is becoming more fragmented and rife with competition. The US and China are no longer directly trading LNG. The EU is preparing to phase out Russian gas imports by the end of 2027. And exporters around the world are voicing more and more concern about the expanding extraterritorial reach of EU regulations, like the EU Methane Regulation, which entered into force in August 2024, and what that means for investment, for trade flows, and compliance across the LNG value chain. The Trump administration has been particularly opposed to those EU methane regulations, with Energy Secretary Wright saying it would disrupt US LNG supplies into Europe, and so requesting an exemption for the next decade until 2035. Fragmenting geopolitics broadly is creating additional uncertainty, depending on the potential for Russian gas export flows, low Chinese LNG demand, whether China continues to halt imports of US LNG. And I just think all these developments raise really fundamental questions about market integration, security of supply, climate policy, and the future role of gas in the global energy system. So that is what I'm really excited to learn from all of you about, because we have, again, some of the best thinkers and experts in the world thinking about all these things who've come together on this Zoom. So I think it's going to be a great conversation. And that's why we've pulled this roundtable together, for a place to have candid, expert-driven conversations at the intersection of policy, geopolitics, and markets. And so our focus is going to be on two critical themes. First, we'll explore where the coming wave of LNG supply is most likely to be absorbed, with particular attention to Asia and the competitiveness of gas relative to coal in key markets. And then secondly, we'll examine the implications of the EU methane regulations for LNG buyers and suppliers, bringing forward a range of stakeholder perspectives and discussing how the regulations design and its implementation might evolve going forward. Just a reminder, it's a private conversation, so held under the Chatham House rule. You can use the information you learn, but not attribute it to any particular individual or identify who you heard it from. We hope that encourages openness, nuance, honest exchange. The Zoom's being recorded, but that's just for our internal purpose. It won't be disseminated, distributed, posted online, anything like that. Just so we'll be doing write-up and taking notes afterwards. So with that, again, thanks to all of you for making time to be with us and for contributing your expertise. And I think I will pass it to Ira now.
Ira, you're muted.
Unmute, so.
Oh, I forgot to unmute. Thanks again, Jason, for summarizing all those remarks. As those of you who I talk to regularly know, the subject of where is the LNG going to go is probably my favorite subject of the many subjects that we have in the LNG business, and we're really, at a real moment here. As I've been in some way involved in the energy industry since 1989, we've had a lot of really key moments and changes and inflection points in the LNG and gas markets, and this is definitely one of them now. And we're really at a moment here where we're going to see a major integration here between particularly the North American gas market and the rest of the world's gas markets, and an integration of prices in a real meaningful way going forward. And we have three really good speakers to talk about these issues with, particularly about where the issue of where LNG demand is going to go. The first of the speakers is Andrew Walker, who I consider one of my Mount Rushmore figures in the U.S. LNG business, as a foundational person in the business, and as qualified to talk about this issue as anybody I know on the planet. So, Andrew, we're really happy to have you here today to speak. And then Anne-Sophie is going to also be speaking as well about some of the narratives out there and some of the cases and possibilities of how strong or weak LNG demand can be around the world, and in those scenarios, what are the consequences of that, both for price and also for policy, of course, and of course, the always ever-present issue of what's going to happen with all of the Russian gas out there, which I'm sure will eventually come up in this discussion as well. And then third, we have Guillaume Perret, who is going to talk about a real critical part of the demand aspects here of this market, where I would say if we were having this discussion 20 years ago, we would have talked pretty regularly about how most of the LNG that's coming into the market is going to be a coal to gas substitution play in Asia. Now, how that's going to work out in the future with the rise of renewables, with battery storage, and also the stickiness of coal, particularly in the Asian energy balances, is something that I'm really excited to hear Guillaume's views on. So, first of all, we're going to start off with Andrew here. And Andrew, and just one more quick thing before Andrew starts. If anybody does have questions or wants to contribute, we'll start the discussion after all three speakers have said what they wish to say. And please raise your hand, and we'll try and pick you in the order that you came in for both comments and questions for the speakers. We want this to be a roundtable. We want this to be a discussion. So any of you on the call, on the Zoom call right now, who does have views, we would love to hear them. So with that, we'll start off with Andrew. Andrew, welcome, and looking forward to hearing what you have to say.
Thank you, Ira. Great. Thank you for that introduction. It's the first time I've been offered a space on Mount Rushmore. I'm not sure what that means. Other than most people who look at Mount Rushmore struggle to name a couple of the personalities, so perhaps I'll be one of those guys who was there in the past, and they're saying, who is that? I don't know. Anyway, you and I have been in this industry a long time. From your intro, you beat me by 2 years, but we have been here for a while, and we've seen it evolve, and I think we're at a very interesting place in terms of its development. Looking forward to discussing it with the group here. I can see from the names online that actually some of my initial comments will be kind of stating the obvious for many of you, because I know I've had these discussions with you. But hopefully we can kind of take that as a foundation to move from stating the obvious to deep conversation and insight. A couple of words on comment. I'm going to make a couple of observations, and then I'll kind of give the Cheniere perspective. So in terms of context, we are about to kind of enter the third supply wave, as has been said. Those of us who've been in the industry as long as myself and Ira remember the trauma of the first wave, 2010, 2011, when Qatar pushed a slug of LNG into the market, 60 million tons over 2 years. At the time, 200 million ton market, that seemed like a huge tsunami of LNG was coming, as was said at the time. I kept telling our trading desk, I was at BG at the time, our US trading desk, this wall of LNG was coming. Eventually it dissipated, the markets worked, this wall didn't hit the US, which was an importer at the time, and the trading desk didn't let me forget that for about the next year. In fact, they had this thing where they would kind of hook their arm like this and say, hey, what's this, Andrew? It's my surfboard, waiting for the wave, waiting for the wave. It hasn't come. So we've been here before, 2016 to 19, there was a second wave, Australia, the US, 90 million tons of growth over 3 years. Again, the markets worked, it was subsumed. And now we're waiting on the third wave, bigger, larger, longer, 180 million tons in 5 years. Surely this is too much for the market. And I think we are an industry that spends, given that we're now cyclical, we spend half our time worrying that there isn't enough supply and then half our time worrying that there's too much supply. And we're certainly tipping into, in 2005, we tipped into that second modus operandi as the coming wave starts to feel tangible. So today's question, where is all this LNG going to go? I think that's actually a proxy for a number of kind of interesting sub-questions, more specific sub-questions, as Jason alluded to. Will we see significant US curtailments? We've seen them once in our history. That was 2020, which was a very specific, hopefully once in a lifetime event, COVID. And to what extent will markets respond, and what does that mean for spot prices, spot LNG prices? How low will they go, and for how long? And another question is, what will the price track be? How quickly are we going to go down? How quickly will we come up? How quickly will we stay at a lower price? And then inevitably at this point in the cycle, we start to talk about increasing buyer power, evolution of commercial terms. Is 10 years going to be the new 20? Is anyone going to sign any more long-term contracts ever, etc.? So I'm waiting for that conversation to kind of start up as well. And as I think Jason said, these are incredibly hard questions to answer. Yes, there's good, strong consensus that as we go into the supply wave, markets will weaken, spot prices will come down. But beyond that, you can see a range of views in terms of the quantum impact of that. Will we see large-scale curtailments or not? So why? I think it's informative to think about why is this such a hard question to answer definitively in terms of the quantitative analysis. And I think firstly, as Jason said, in LNG, supply is easy, demand is inherently hard. One, I think it's very hard to tie down the price elasticities in terms of price versus demand in a lot of these markets. There's a limited track record in terms of assessing these at the scale we're kind of talking about. And there's clearly a behavioral overlay from the buyers who kind of look at forward curves or look at how they think the market's going to evolve, and sometimes don't kind of go in the direction that you're thinking they're going to go. Secondly, LNG is now a global system, so it's not good enough to just have a good view of one market somewhere. You've got to do everything everywhere, and you've got to do it well and add it all together and get a coherent answer. And that, I think, is hard. And then secondly, I think it's very hard to differentiate between what I would call organic growth, that's gas markets growing out as they add infrastructure customers, CCGT as they grow their industry, versus price elasticity, which is the kind of overlay of that. If gas is cheaper, how much more gas will they take in that year? And it's very hard to differentiate the underlying organic growth with the price response in each year. Secondly, not only is demand hard, this is not a closed system. So you're not only going to have to think about gas, you've got to think about oil price, you've got to think about domestic US gas prices, Henry Hub, and to some extent carbon prices. Those will influence the outcome. The global model for wave 3 has clearly changed. Wave 1 and 2 worked with the supply push and Europe as the backstop balancing market. That is no longer the case, with Europe having changed post-Ukraine. And then finally, as Jason alluded to in saying nothing much has happened recently, we've got as much geopolitical overlay here in hydrocarbons, oil, gas, energy as we've had for a long, long time. So having said this is a hard question to answer, I'll kind of give the Cheniere perspective, which is we are believers. We've done our modeling, our balances, and when we look out, we don't see that the industry is going to experience significant, large-scale, sustained curtailments. We don't think we'll see that. And quite often when I hear consultants talking about curtailments, I kind of look at their US utilization factors and have to remind them what they're actually talking about is 3-5 percentage points lower utilization, which may be softer production across the board. It may be some curtailments in the shoulder month. It may be some reduced exports, increased maintenance during the summer, but this is not large-scale curtailments like we saw in 2020. And so why are we believers that the markets, that we're not going to see curtailments? One, as I said, there's the experience of the first two waves. Markets work. We've seen them perform. We've seen them respond to lower prices. I've no doubt that they will do so in this wave. The coming wave, although it's bigger, longer than we had before, each of those was bigger and longer than the one prior. But also, don't forget the underlying trade is bigger. The global market has grown. It's more flexible. It's more liquid. It's more efficient. It should be able to clear the surplus more efficiently. LNG infrastructure, I don't think, is an issue. We've looked at total effective infrastructure capacity. There's almost 3 times as much import capacity as there are markets. So we know there's the infrastructure to take more. And if we look at a kind of coincident peak, which is kind of more an electricity thing than a gas thing, but if we look at the maximum that these markets have taken and add that together, we could get to 100 million tons more than we are today based on the 6-month coincident peak. If you increase that to a 1-month coincident peak, then it's nearly 300 million tons more. So we know these markets can do more if they're incentivized, and they can do more in aggregate. Finally, we're seeing, I think, an increased pragmatism on the achievable speed of the energy transition. And I choose my words very carefully there. I think that's to the advantage of gas. We're seeing a lot of people say gas is going to play an important role. It's going to be here longer. I think that means that we're going to see a sustained role, an increased role for gas over the coming decades. Where is the LNG going to go? We at Cheniere have been quite consistent in our messaging over the past 3 to 4 years that in future, as we look out across our forecasts, we see Asia being the key driver based on fast-growing economies, energy growth, translating to energy growth, translating to gas and LNG growth. And as the burner of the majority of coal at the moment, a desire to reduce emissions will advantage gas. And I think we've generally talked about that in terms of a 2040 profile, but if we dial that back to 2030 in terms of the coming wave, it's predominantly the same answer. It's Asia, but in probably a slightly different mix. Over the longer term, we have 3 pillars: China, South Asia, Southeast Asia. In the near term, China becomes slightly more important in terms of the balance than the other two, but it is some of all of those. Shipping bunkers will also be helpful, and we're a believer that we're going to see some price response in Europe as spot prices go lower because we believe in markets. So that hopefully sets us up for a conversation with some obvious comments and some things that are perhaps helpful in terms of the foundation for discussion. So back to you, Ira.
Perfect, Andrew. Thank you. Yes, I already listed multiple questions for myself for when I hear back from you, but we'll wait on that. And again, if anybody does want to contribute to the discussion, please raise your hand. And now we're going to move on to Anne-Sophie, who will talk about various LNG narratives other than the ones that Andrew just painted.
Yes, indeed, because I mean, you will see that there are some common themes between what Andrew has just painted and what I'm going to say. And indeed, I mean, we are looking at an unprecedented third wave of LNG supply coming to the market. I think we can maybe disagree on how rapidly this is coming to the market. Just as a reminder, I was also looking at the previous waves of LNG, especially the second wave of LNG, because this is when I was working on a book with some friends of CAPSAC and OIS that I see also on the screen. Hi, guys. At that time, we had an increase between 2015 and 2019, we had an increase of about 150 BCM of LNG supply. 43% went to Europe. 39% went to China and only 22% went to Asia. And actually, there were some declines to MENA countries and Latin America. So when we are looking at the new wave of LNG supply, it's going to look a little bit different. But right now, what we see in terms of the LNG narratives are two different worlds. The first one is where LNG demand is growing pretty fast and pretty strongly and absorbing actually all the LNG supply which is coming to the market. And this is also because, well, we don't know what the real LNG demand is, given that we have been experiencing for the past 5 years relatively high gas prices. So Europe has been absorbing LNG, but we don't know what a world with lower gas prices would mean for demand in Asia, specifically in Southeast Asia. The other completely different narrative is a world where, well, there is simply too much LNG coming to the market. We don't know actually where the final demand is, because a lot of the LNG has been contracted by the so-called aggregators and the traders. And even the Chinese companies such as Sinopec, CNPC, etc., are now becoming aggregators on their own. So it's not giving us a lot of visibility on where the final demand is really. And of course, in this world, well, this is where basically gas prices, global gas prices, are crashing down to the short-run marginal cost of US LNG, potentially driving us towards a world where we have US LNG shut-ins. And well, the big question is how much LNG shut-ins you have, whether you are going back to the world of 2020 or something in between. Now, I am not going to talk about coal because Guillaume is going to talk about that. And by the way, I should highlight that Guillaume, unlike most of us, is a real coal expert. He's a bit different from us. And that's why, it's quite good to have him, because we tend to talk to ourselves in the gas industry. So it's good to have somebody from the outside world talking to us about the coal world. And I have had the pleasure to actually be the gas person talking to the coal people in different conferences. But what are the different signposts which can lead us towards one or the other world? Where, when we are looking at the relatively bullish scenario, well, you can see that, there are signs which are telling us, okay, LNG demand is actually going to be much higher than what we expect. For example, let's look at Japan. If Ken Koyama from IEJ was around and unfortunately couldn't make it, he would say, well, Japan has a new energy strategy. There is a plan A, which is consistent with reducing greenhouse gas emission, and there is a plan B. But actually, plan B is plan A, and this is leading to much higher energy demand than what we thought before, especially given that electricity demand in Japan is increasing. Korea has just announced a plan to shut down their coal-fired plants by 2040. So this is also quite bullish for natural gas demand. In Southeast Asia, agree. I mean, we have both a demand because domestic gas production is declining, but also because there is a potential for increasing gas demand due to electricity demand rising. And finally, we have also, India, city gas distribution growing quite strongly. In China, we have LNG trucking. And finally, well, there is Europe. Europe, which has just reached a new record, EU countries, 145 billion cubic meters last year. We don't know what it's going to be this year, but Europe, the question is not so much about the demand for natural gas. It's about the ability of oversupplies but LNG to actually meet that demand. And let's not forget that we are moving towards not having any more Russian pipeline gas by the end of 2027. And there are also relatively big question marks about the future of Norwegian gas supply, North African gas supply. So this is leaving a door open for LNG. So these are all the kind of bullish factors towards a higher LNG demand with, of course, somewhere in the background, there is also all these stories about AI and data centers, which are driving up electricity demand. I should also add that this is a demand side story, but in this kind of bullish scenario, there is also a question mark about LNG supply. What if actually LNG supply is not as strong as we initially expect? Because, well, LNG supply is coming with delays, whether they are strategic, and this is referring to the paper that we did with IRA on Qatar, or whether this is just because the plants are arriving late, and Cheniere's plants are not arriving late, but some other plants in the world have been arriving with some notable delays. Or whether, there are sanctions imposed on some specific plants. Arctic LNG 2, some other plants in Russia have been already sanctioned. Arctic LNG 2 is trying to survive. But what if the US would be imposing sanctions on Yamal or Sakhalin? I know that this is something that is worrying very much the friends in Japan, especially for Sakhalin. So these are things that we need to think about. Meanwhile, let's have a look at what could actually be building a case for oversupply. Well, in the background, there is always Russian gas, the stories about Russian gas and whether or not it's going to come back or whether it's going to stay. This is going to stay as a major uncertainty. But if I am looking at different countries, for me, the biggest concern is about China. Andrew mentioned that as a potential big driver. I'm concerned because Chinese LNG demand over the past few years has been really on a roller coaster. And to what extent this is really going to grow when you have so many different parameters is kind of questionable. I would be concerned about, betting too much on something which for me is the adjustment variable in the whole Chinese energy policy. And let's not forget that since last year, with the trade tensions with the US and Qatar, we have China considering LNG much more as a geopolitical risk. Looking at other countries, well, there is Southeast Asia. So, okay, replacing domestic gas production is one thing, but gas demand has not been growing for almost 10 years in this region. So that's something important. And when we are talking about, oh yes, there is going to be growth in the electricity sector where yes, but do they have access to gas turbines? Because everybody wants a gas turbine right now. And my understanding is that some of the Southeast Asian countries are actually in the back of the line. So that's also a big question mark. India, I have had a lot of reports written on India. The first one was 2010. And my experience with India is that they're always more optimistic than what the reality actually is. And you need to be quite cautious. Also in Southeast Asia, you also need to build the LNG import capacity. Finally, well, there is Europe. And as much as you can have some question marks about natural gas demand, which I have to say, is going to be increasingly concentrated in two sectors, residential and power generation. This gas demand is going to be more and more volatile. So you might have some spikes in terms of LNG demand, but I think structurally gas demand is going to be down. Now, I am sorry I have to say that, but I think there is going to be also a question mark about what EU leaders are going to do if the US decides to take over Greenland by force. that's a new question mark since the beginning of the year. So this is leaving us with a lot of question marks. I hope I have basically brought some teasers for the next discussion, and that we can now have some true coal expertise, and leaving the floor to Guillaume.
Thanks, Anne-Sophie. That was fabulous, and definitely rounded out some of the other scenarios, but some of the more bullish ones out there that sometimes don't get talked about as much. So we're going to move on to Guillaume here, who I'm very interested in to hear. And Guillaume does have a couple of slides here for those of you who want to look at your screen while he's talking, because the relationship between coal and gas is something that is so critical to the demand story, not just for LNG, but for domestic gas use in a lot of countries around the world. And Guillaume, why don't you take it from here? And we look forward to seeing what you have to say.
Thank you very much, Ira. Just to make sure you're hearing me and you can see my screen,
You're good.
slide, yes?
You're
Okay,
good.
cool. All right. Hello, everyone. It's good timing because I'm just sharing here with you some of the finding of the latest report, the long-term price forecast report we have published recently, and it's focusing on coal and freight. If it moves. As a summary, coal to stay for much longer than expected. I think we'll summarize what we are saying here. I'm starting with electricity because 70 to 80% of the steam coal demand worldwide is for the electricity segment. And we expect growth overall in electricity demand worldwide. So we are not seeing any peak. I'm talking about peak here because many people talk often about Chinese peak in China in terms of coal demand, electricity demand. Just focusing on China, we don't see any peak in coal demand. And we can extrapolate that to power demand in most countries worldwide. If we just look at the electricity consumption per capita, there has been growth overall in recent years. We expect that to continue. We expect even growth in the most advanced economy, starting from the US or with the US, but including Singapore and Europe, because of the new developments of data centers and electric cars. But the bulk of the growth in electricity demand will come from these countries here at the bottom. You can see that very large countries in terms of population. India is now the most populated country on earth, have still a very low consumption of electricity per capita. India is 1.2, 1.3 billion people. Philippines is something around 200, 250. Indonesia, the same. Vietnam is 90 million people. So just here in this part of the chart, I would say you have about 2 billion people basically. And our base case scenario is that these countries will steer a growth in average consumption from the 2,000, 3,000 kilowatt hour per capita up to the 4,000 to 5,000 kilowatt hour per year per capita over the next 10 to 20 years. And this is going to require significant quantities of electricity, obviously, and fuels to a certain extent. Another element I would like to highlight is the CO2 emission and the CO2 emission cost, and in particular, the metrics that are used. The EU bloc, which has been a precursor in the CO2 market since 2005 and the launch of the EU ETS market, is probably the most advanced in a way and the most rigid about it because, as you know, in Europe, we count the tons of CO2 in absolute numbers, I would say. And obviously, depending whether you are running a coal power plant, a gas power plant, a cement plant, the estimate of the usage of CO2 you are using in your plant is adjusted to the fuel you are using. Many countries and in particular in Asia, are looking at it slightly differently. And there is always a but or if I would say. Meaning that they don't look necessarily only at the tonnage or the tons of CO2 emitted, but they will normalize it or adjust it either on a GDP per capita basis or just on a per capita basis. And obviously it changes many things because countries that are emitted a lot of CO2, in particular India or China, which would be at the top of the chart, I would say, if we were only looking at the total CO2 emissions, are actually in the middle or at the bottom of the chart if you adjust per capita. And many of these countries are now saying that they are going to experience significant growth, economic growth over the next 20 years or so, that they are going to emit more CO2, but that this CO2 needs to be calibrated or adjusted on a per capita or a per GDP basis. These also mean that we think that the CO2 cost, which has been very penalizing for the coal usage in the EU bloc, in particular today with CO2 emission cost at around 87 euros per ton, will not be so punitive, I would say, for coal usage in other countries, in particular in Asia, because there will be some kind of adjustments. Another thing to highlight, and I'm focusing here now on renewables. It's a very simple calculation here. We look at Germany, for instance, and in 2021 and 2024, and we just compare the capacity, the actual capacity per sources of electricity. We only focus on electricity generation here. The actual electricity generation in terawatt hour, and the simple, very simple ratio of actual generation terawatt hour per gigawatt. And we can see the very wide disparity between the sources of electricity. And nuclear is by far the most efficient source of electricity, generating about 8 terawatt hour of electricity per gigawatt. And at the bottom, you will find solar and wind, solar being the less efficient, I would say, 0.9 terawatt hour per gigawatt, and wind 1.8. And coal is somewhere in the middle, 2.9. Lignite is more efficient. Gas was in 2021 at 1.5 terawatt hour per gigawatt. Now, if you look at 2024, as we know, Germany shut down completely the nuclear generation, which just looking at this table can raise a few eyebrows, because you could say that Germany has basically closed the most efficient way of generating electricity. Germany invested significantly in wind and solar. The wind and solar capacity have increased significantly between 21 and 24. They have increased even further in 2025. The total quantity of electricity has obviously increased, but if you look at the ratio, it has been stable, or it has even decreased if you look at solar. So as we know, or as we assume, or as we can guess, but here we can see the hard data, you need to build significant quantities of additional wind and solar capacity to either sustain growth in total power generation in a given country, or to replace existing sources such as coal in the case of Germany and Europe. Now, if you look at China, we have actually similar numbers in terms of ratio. Nuclear generation is in China as well by far the most efficient way to produce electricity, followed by coal, followed by hydro, which is the most efficient renewable source, I would say. And wind and solar are below that, and actually the ratio for solar is way below 1 terawatt hour per gigawatt. So I'm sharing here with you a few findings, or it's an official statement from the Asian Center for Energy, ASCE, which regroups Southeast Asian countries, which are listed below. And I find it quite interesting because we have seen quite a turnaround in the world, I would say, and energy policy since the energy crisis of 2022. I would say that during the period 2010, 2020, basically, Europe was the model for many countries in the world, including in Asia and Southeast Asia. And broadly speaking, most countries were kind of following, in a way, the lead from Europe in terms of energy policies, which meant fast energy transition, CO2 tax, gas to coal or coal to gas switching, and gas as the intermediary fuel, let's say, between a full on coal and a full on renewable strategy or policy. And these countries have seen what happened in the world, and in particular what happened in Europe with the energy crisis of 2022, and in particular with the closure of nuclear and the high dependence on wind and solar, and to some extent, one could say, the premature closure of some of the coal power plants, which resulted in skyrocketing power prices. And so they came with these new statements. It was just 12, 18 months ago. Coal provides sufficient energy supplies at the lowest cost possible. Transition away from coal should be done in a just gradual way when economically and environmentally viable alternatives are available at grid scale. Coal currently outperforms other energy sources in terms of supply, security, reliability, affordability, and to some extent sustainability. I'm coming back to the grid scale because in many countries in Asia, as an introduction to the coal gas story, the gas generation is still negligible in many countries in Southeast Asia or in Asia, including in China and India. Net zero emission pathway is overly ambitious and not sufficiently tailored to the unique circumstances found in Southeast Asia. So this is back to the chart I've shown you on the CO2 per capita. It is essential to also provide clarity regarding the utilization of methane, basically, for electricity generation. And there will be a session on methane later today. So these were comments that were provided, I would say, in a backdoor, non-officially at coal conferences or at some energy conferences, in fact, before 2022, 2023. But what was noticeable and interesting is that it was written in an official report from an official government body just a few years ago. And this is a new development. So the question I was asked to answer to, can LNG displace coal in Asia? Well, the short answer is it will probably take much longer than what people think, to summarize also, or to repeat what I said first. I give you here, because Asia is very diversified. So we need to zoom in a little bit and focus on some countries. So if we look at China and India, at the moment, gas is negligible. If we look at power generation to the grid, gas is negligible. We are seeing growth in gas and LNG usage, mainly for the industry, with the captured gas power plants running various industries in these countries. We think that to a large extent it will remain so. So we don't see a significant growth in gas and LNG usage for power generation in China and India in the coming years. We anticipate a very slow rise in the CO2 tax as the priority remains economic growth. In fact, for these countries, the main competition, as far as we can see, comes from wind and solar. And this is true also for Asian countries, but in particular for China and India. China is now, you have many months in China now where wind is the second source of electricity after coal. Traditionally, the largest sources of electricity in terawatt hour in China used to be coal, and then hydro, and then nuclear, and then wind and solar. Given the significant investment in wind capacity over the last 5-10 years, we have months now when wind, and in particular during the shoulder periods when hydro is relatively low, where wind is the second source of electricity. And we anticipate that either this year, 2026, or next year, 2027, wind will become the second source of electricity generation in China on a yearly basis after coal and ahead of hydro. Gas is negligible. Japan and South Korea. Japan and South Korea were following, I would say, almost blindly Europe back 10 years ago, as I mentioned. We have seen a strong coal to gas switching between 2015 and 2022. More recently, we have seen a stabilization in coal demand. We still expect a slow China and India are still building coal power plants, by the way. And to some extent, they are even accelerating the build-up of coal power plants. Japan and South Korea, they are not building more coal power plants. We think they are going to keep their coal power plants. And as it has been the case in many countries, we think they are going to keep them for longer than what they say. So if at the moment they announce a closure by 2030 or 2040, in our long-term planning, we expect that they will keep them for longer. We have seen a strong revival of nuclear generation in Japan and South Korea, which is providing a strong volatility in terms of spot coal usage. And we have seen it last summer of 2025, in particular in South Korea, which became over-reliant on nuclear generation. But we saw, for many reasons, a problem both in terms of nuclear generation and transportation of nuclear power from the East Coast to the West Coast. And all of a sudden, the South Korean Genco had to restock coal in a kind of hurry. And this provided a spike in the coal market and in coal demand in July, August, and Q4 2025. We saw a recovery in South Korean imports of Colombian coal, for instance. So Japan and Korea, I would say, more kind of a slow erosion in coal demand in a structural way, but no collapse. And Southeast Asia, so Philippines, Indonesia, Vietnam, Malaysia, cheap, low CV Indonesian coal has been fueling their economies over the last 10 years, and we think it's going to continue. Low CV Indonesian coal is by far the cheapest source of energy in this part of the world for electricity generation, apart from renewables. So here again, we see competition growing from wind and solar mainly, but these countries are not going to be able to increase their wind and solar capacity as quickly as China did, just because China was, for them, it was a way of fueling their economy in a way by building more solar panels that they were using locally. Most of these countries will need to buy and import solar panel, in particular from China. So we expect a slower growth in renewable capacity in these countries compared to China. And maybe last, Taiwan. Taiwan, I would say, is the outlier in what I've just said, because Taiwan has taken a very bold energy policy in our views, and a very risky one, which is to phase out nuclear and to accelerate coal to gas switching. Even if coal is more competitive than gas for power generation, there are strong incentives in Taiwan to use more gas. This means that Taiwan is very exposed to LNG imports from various origins. And given the political situation, the uncertainties that we are seeing in the world, we are very nervous in a way with what could happen to Taiwan in case of further escalation of the tension between China and Taiwan. And if there is or there are any supply constraint, let's say, in terms of LNG imports to Taiwan, the country has like 2 or 3 weeks of LNG inventories to keep running. So we think this could be one of the shock we could have in 2026 or 2027, and one that could have quite a serious impact on energy prices. And this is it for my presentation as an introduction. Thank you very much.
Thank you so much, Guillaume. That was a great presentation, and particularly we'll pick up in a little while here on your coal for longer scenario that you talked about in Asia. So to start the discussion, I wanted to go back to Andrew on 2 specific points, Andrew, that I would love to hear more comment on this. And one is very upstream and one is very downstream. So the very downstream one is since you started exporting in 2016, I'm really curious to hear the evolution of your thought on Indian and Chinese gas demand, particularly LNG demand over that period of time. Because since that time, we've clearly had, obviously, a big increase in renewable capacity, the amount of renewables that are entering the market. And I'm sure in some way that has definitely evolved your thinking on those 2 markets. And within those 2 markets, and I think more broadly, what specifically, if LNG is not going to have a groundbreaking influence on coal switching in Asia, what sectors do you see out there where LNG is really going to sort of make a a material difference in terms of growth. That's one part of it. And then the other one was, I want to pick up on this issue that you said about no curtailments coming forward, particularly from the US. And so I've always thought, at least in my own thinking, is that we're going to have one or two type of curtailments here in a curtailment environment. You either have to curtail the LNG exports, or you're going to have to curtail, or in another use of another word, cut US gas production. So in a no curtailment scenario for US LNG exports over this next 5-year period, where we're going to average close to 40 million tons a year, which I'm pretty sure we've never had even in a single year in the history of the LNG industry, let alone 40 a year for the next close to 40 a year for the next 5 years. That to me sort of implies a very, very low Henry Hub price at times. And when I'm saying low here, I'm saying like below $1 if there's not going to be any curtailments on the US LNG export sides in order to keep US LNG exports profitable in a scenario where TTF and JKM prices come down. So I know that's a lot to answer in there, but so there's the India-China question in terms of your evolving thoughts on that over the past decade and into the future. And then also the curtailment issue. And then one other thing, let me just mention in there before we start the discussion is, are you having a change in view on Chinese gas production itself? Because it seems to be ramping up pretty quickly and moving faster than it had a few years ago, both on the shale side and the conventional gas production side. Thank you.
Thanks, Ira. A lot to unpack for a single or two questions there. Yeah, in India and China, and really this. My comments I would kind of couch against the coal forecast that we've just seen, where there was a suggestion that gas is insignificant in the Chinese market, and certainly gas into power is insignificant. This is really a question of scale. We have to bear in mind that in many markets, and China is a great example of this, gas and LNG are a fairly minor piece of the mix. We know that, yet China is a huge energy market, fastest growing energy market in the world. And so quite small movements in that can have a big impact into gas and into LNG, as we've seen. China can quite easily swing in or swing out 20 million tons of LNG based on small movements in either energy or other fuels. So actually our view on China hasn't really changed. We've always known that gas is a fairly minor piece of the mix, and LNG is kind of a quarter of that. But that still results in a world in which China becomes the second biggest gas market after the US, and that it becomes the only LNG market ever to break 100 million tons. So the question in my mind, and when people talk to me about China, how quickly do they phase out coal? How quickly do renewables grow? Yes, all of that's important. But I don't really see anyone who diverges from a view that China will become the second largest gas market and the largest LNG market. And so I think it's a case of yes to all that's been said, but even so, that doesn't undermine our view in terms of where China gets to in terms of LNG demand. The question, perhaps the more pertinent question, is given the Chinese economy, the slowdown that we've seen, not a slowdown in energy demand per se, but a slowdown in gas demand. Key question for almost all of these markets in terms of where we are at the moment, how much of this is structural versus temporary? How much of this slowdown means that China will become the world's first 100 million ton LNG market, but maybe a couple of years later than we thought it was going to be than previously? So our Cheniere's thinking on China and India has been pretty consistent over the time I've been there, the last decade, in that we see China as a huge growth market. How quickly is perhaps the pertinent question here. And we see India as a growth market for the reasons that you talked about: build out of infrastructure, less so power, more so industry, to some extent, commercial, transport. And I guess India has, over the course of my career, your career, been one that's been kind of the tomorrow market for gas and LNG. And I think we're finally getting to tomorrow, where we're seeing the intent, the build out of infrastructure, plus the evolution of regulation that means I think gas will grow. They probably, with all due respect, won't reach the 15% of the energy mix that they have targeted. But again, India will grow, and we've taken our view in our outlook as to how much we think it's going to grow in a considered and realistic opinion in our view. And again, we get to that 600 million tons without, and I chose my words very, very carefully, significant sustained curtailments. It's not going to be 2020 all over again. I don't think we get to that point based on the current supply track. I know, and I can see Mike has got his hand up, there are people who do in-depth modeling on these markets, so I'll let them talk about that to some extent. For your second point, given I don't think that we see sustained curtailments, I don't think we're into this let's turn the LNG exports off and then what happens to the domestic market. That would be a fascinating experiment, but I don't think we're going to see that on the scale that perhaps you might wish to see from a inquisitive perspective. That doesn't mean to say that I don't think it's going to be it's not going to be volatile, because I think it will be. And as the markets react to geopolitics, headlines, etc., we could see some swings in terms of expectations. But we really don't know, to some extent, how this mechanism works. There's a big spigot marked on or off, which doesn't, work for the market. There are lead times, there's a forward curve. I think this is going to be a learning process. It's going to be very different from the 2020 case, where clearly demand was lower and there was a need to curtail that was understood. And so it was done in a relatively orderly fashion. This wasn't the market versus, internal market versus external market that we would be into in terms of the supply and demand swings. And once Henry Hub goes to negative, then people will be buying LNG like there's no tomorrow, so it will all turn back on again. I mean, I don't know the answer to this. I just suspect it's going to be volatile and there's going to be a learning process. And I don't think we're going to see it on the scale that perhaps would make this the huge swings that you perhaps have in mind. Having said that, I can see a bunch of hands, so I'm interested to see the views of some of the colleagues there.
As am I. Thank you for that very thoughtful answer. Mike, your hand was up first, so if you could please join in, and you're unmute. Thank you.
Thank you, Ira, and thanks for the presentations. Apologies about my voice. I've had a cold for about a month now, so just about recovering from it. Just want to make a few comments. Obviously, some of you may have read, if not all, our $6 gas paper we did at Oxford, at least the executive summary. Some interesting things sort of coming out of that, where we asked our various experts in the regions to look at the potential additional gas demand if prices dropped to $6. And one interesting thing came out of it, it wasn't all about coal to gas switching. In fact, almost half of the additional demand came out of industry and transport. So coal to gas is important. And I think, as Guillaume said, it wasn't really coal to gas switching in China and India. It was more coal to gas switching where countries are importing coal, which obviously is more expensive than indigenous coal. But it was industry and transport where you really compete with oil. So that was one of the big things. I mean, China and India were doing a lot of heavy lifting because of industry and transport, but also Japan, based on their Plan B, which is now Plan A, where there's still a lot of oil-fired power left in Japan, which you can kind of switch away from. Not so much in Europe, where with the coal plants closing, there's less room for sort of switchability in the power sector. But just echoing what Andrew said about the first and second waves, we saw demand absorbed as prices dropped, and that's what we saw in the $6 gas case, is that The prices dropped to $6. You got sort of 8 to 10% boost to LNG demand, which meant the market cleared, not with dramatic oversupply, with just a little bit of oversupply. So that's kind of what we saw. Just on the curtailments point, I think I would agree, Andrew. Even with $6 gas, if we had $4 Henry Hub in our scenarios, you don't get curtailments. In 2020, the differential had to drop well below $1 before we saw curtailments, because you're still with a $2 gap getting some contribution towards your fixed costs. So we, like Andrew, we don't see any reason to see any curtailments unless prices plummeted to sort of 2019 or 2020 levels with $2 and $3 gas. Then you might start to see some. Thank you.
Thank you, Mike. Tim, you're up next.
Thanks very much, Ian. Thanks very much, colleagues. Really interesting stuff. I did want to come back to something that Andrew said, because he made two statements up front. One is that, I guess, in aggregate, there's no infrastructure constraint. And then you said that you see the biggest growth in demand in Asia. And I just wanted to quiz you on whether you can put those two statements together and say that you don't see any infrastructure constraint in Asia. And that's certainly true in some parts of the region, but our impression is that you would need to see additional infrastructure build out for regas capacity in parts of Southeast Asia. And so I'd appreciate your thoughts on that. And I guess a comment reflecting a little bit on Guillaume's presentation and building on also what Mike was saying. You know, our impression is that, you know, when you do have these kinds of gas discussions in India or in some other parts of Asia, you know, a lot of the international folk, a lot of the policy-minded folk talk about gas and coal. A lot of the people who are really looking to make the numbers work, make the sort of commercial case for bringing in LNG, are looking to switch out liquids and getting back to comments about the importance of the transport sector, but also particularly of industry. So I'd really appreciate to hear views on how much, when you look at the region, how important is that gas to liquids switch in, you know, making this work and to absorbing all the new LNG coming to market. Thanks.
Ira, do you want me to take the infrastructure question first?
Yes, thank you. And again, if anybody does have any comments or questions, please do raise your hand. Thanks, Andrew.
Tim, yeah, you're correct. I was talking in the aggregate, really, in terms of aggregate. 1,200 million tons plays 425 million tons of trade. So there are some places where there are bottlenecks. Taiwan is a great example where they're running, you know, pretty much at capacity in terms of how much they can import. When we look at our coincident number, you know, when I said the industry could take another 100 million tons, obviously that becomes limiting in places like Taiwan. And then as you look forward, you kind of look at their build out. And so what gives me confidence as we go through the next 5 years, the next 10 years, the next 20 years is that there are plans in a lot of Asia to build out capacity. China, of course, the big market that we've talked about, is building huge amounts of import capacity, almost equivalent to Europe's import capacity. And Europe has been adding some capacity recently post-Ukraine. So, yeah, I was talking in aggregate. There are constraints in individual places, but there are also plans to continue to grow that infrastructure that I think will allow capacity to continue to grow. FSRUs allow a quicker solution as well than the kind of traditional terminals. So you can see the market respond more quickly where there are capacity constraints.
Thank you, Andrew. Someone is not muted. If I could ask them to mute their computer right now. Jean-Baptiste, you have your hand up. Any thoughts? You're muted right now.
Sorry.
Thanks, Ira, and big thanks to Andrew and Sophie and Guillaume for the overviews. Just like to add my 2 cents to the open list of question marks that and Sophie raised with the dynamics of the US market, because I understand that gas demand is poised to rise with the development of new export projects on the one hand, but also with that flurry of new CCGT projects that we see since last year to feed the electrification with the data centers and all of that, given that the renewables growth is on pause. And on the other hand, the fact that the major resources from the Permian are peaking, as the DOE recently mentioned. I think that Chevron said that they expect to see plateauing in a context of lower, if not lower, lowering oil prices, and therefore less potential for cheap associated gas to come to the US market. So in a nutshell, what I would be very interested to hear your views on what could be the impact for the cost and the availability of the feed gas for US exports. Thanks.
Let's have you answer that first, and then we'll switch to Guillaume.
Do you want me to have a first go, Ira?
Yes, please. Yes, thank you.
I think, again, big picture, the US is not running out of gas anytime soon. It has a huge amount of gas. If you look at most folks' consultants' cost curves, they've got about 1,200 TCF at $4 or less. And there's, I think, about 3 to 4 times that, 4,000 TCF was the potential gas committee number from this year. That 1,200 TCF at $4 or less has been a fairly consistent number for quite a while now. So actually what the US is doing is it's not running out of cheap gas, it's just translating gas from that potential technically recoverable to economically recoverable. It's doing more with less, longer laterals, etc., etc. I think that's going to be the story as we go forward over the long term. As with any market, supply and demand, we may get mismatches as the market grows. We're certainly going to have a rapid increase in LNG demand. AI demand, we just don't know. But it's certainly not going to be on the scale of the increases in LNG demand that we're seeing. We're running 19 BCF a day at the moment into the existing LNG export fleet. We're going to double that by 2030, early 2030s. But the market knows it's coming. It can see this demand. It's being sent pretty good price signals. It's going to get out of bed. It's going to respond. So I have no doubt that there may be periods where there's cold weather and we may see short run mismatches. Over the long term, the US, I think, is the most efficient, best balanced market in the world with a huge resource. So I believe in markets. I believe in the US market. I believe in the LNG export markets. Doesn't mean to say we may not get imbalances, but markets tend to work back towards balance if they can.
We'll come back to that in a second, Andrew, in terms of what it means towards price. But let's switch to Guillaume for a second, because first of all, you had your hand up. But Guillaume, I also wanted to ask you, when Andrew mentioned price elasticity versus organic demand, that sort of is definitely an issue in Asia when it comes to coal to gas switching. And I was wondering if you could sort of comment on what kind of sustained JKM spot price or spot LNG price in Asia would we need to see significant changes in terms of coal to gas switching in the region going forward? And then, of course, whatever other comment you had.
Okay, thank you, Ira. First of all, I wanted to come back to Tim's question, I think, on gas to liquid switching. And I just wanted to clarify what he has in mind, if it was gas to chemicals and petrochemical, for instance. This is for Tim Gold.
Tim, was that your question? Was it an NGL question?
It was partially that, but also just switching out of liquids used in industry, which is still fairly widespread in parts of India, and likewise then the competition that you get through building out the city gas distribution networks for liquids use in transportation.
Okay. No, it was because as far as coal is concerned, but I think that gas and LNG are concerned as well. We have seen a significant rise in China, in particular, in coal to chemicals and petrochemicals usage. So coal is not only used for power generation, but also for in this chemical and petrochemical segment. And this is quite significant because this was the largest segment in terms of growth in coal demand last year in China. And I suspect that some of the gas can be used as well in the chemical and petrochemicals. So it was just on the side. On Ira's questions and cost, one of the significant development in the coal market, I would say, since COVID actually, is that the average cost of production of coal has increased quite significantly. First, and second, in this new cycle that we think we are in a new cycle in terms of coal, meaning that even if we had FOB Newcastle prices at $400 a ton in 2022 and even at above 150 in 23 and 24, we have not seen significant investment in new coal mines, I would say, worldwide. In fact, we have seen a contraction in many countries, including in the US. Indonesian coal production has increased a little bit, Australia to some extent. But for instance, just talking to Australian coal miners, it is very difficult not just to find people working in mines. And the timeline to invest and to open a new coal mine or a new mine in general in Australia, for instance, which used to be 12 to 18 months, is now easily 3 to 4 years. When you have the investors, when you have the financing, and if you get all your compliance right. Meaning that the new cycle is different in the sense that the historically high coal prices that we have seen over the last 3 years have not triggered a new wave of investment in coal as we had, for instance, in the last big bull market of 2010, 2011, which triggered the doubling almost of Indonesian coal producers. So the kind of new wave of LNG that many people are talking about here is not really happening in coal. And I would say it's potentially a supportive element for both coal and LNG. Is that and back to also one of the comments I think from Andrew is that supply is easy, demand is difficult to forecast, I would say, in LNG apparently and gas today. It used to be the same for coal, but I would say that nowadays in coal, the supply is much more challenging to forecast than the demand and potentially the cuts in supply. So I don't have a number in terms of GKM where you really start to see coal to gas switching. And we are going to look at that into much closer, and I would say. But I would say that if you look at the current prices for Australian coal, which is, to some extent, a direct competitor to LNG prices, Northeast Asia. If you look at the Newcastle high CV coal, currently is at $105-ish a ton. The Newcastle mid CV coal is at around $75 a ton, I would say, FOB in Australia. We see very little downside on these prices, meaning 5-10% maybe, if some mines have to struggle and go through this wave and this cycle. But if we really see an aggressive drop in gas prices worldwide, including in Asia. Asia is a bit more complex because you still have the CO2 tax or the absence of CO2, which makes coal still very competitive. But all being equal from current levels, I would say, if the market drops, I mean, that's at least our base case scenario, if the coal prices drop by 5-10%, for sure, we will not see any increase in coal production. And we are quite likely to start to see some temporary or permanent closure of some coal mines in Australia, but also in Russia. I was just reading a report, the Russian coal mining industry will lose about $5 billion in 2025. Just because of the low prices and the challenges in terms of domestic transportation, etc. So there is not a lot of room for maneuver in terms of downside for coal prices. And if there is really an overcapacity and an oversupply on gas, we don't think it's necessarily super bearish coal prices, because, as I say, we are getting close to the cost of production. But this means that we could see some acceleration in terms of coal to gas switching, just because the coal miners are not going to fight to the death if gas prices collapse. I mean, at least that's our views.
So when you frame it that way, and this is interesting that it is coal to gas switching, could you give me sort of a broader picture of how much you see coal being substituted with gas versus coal being substituted with renewables and batteries in terms of that substitution pattern? Because I sort of flippantly said coal to gas switching, like less coal, always going to be more gas, but clearly there's some competitive force here, at least in the power generation sector. And I wanted to look at what sort of the balance is in the terms of the substitution effect if and when we do lose coal over time.
And Ira, let me weigh in because I can't find my raise your hand mechanism. It would also be great because you're mentioning this thing about coal miners being constrained, but a lot of the mines are going to robotics. So how does the modernization of coal mining affect the costs and questions?
Thank you, Amy. Guillaume?
Well, in terms of robotization of coal mining, I would say yes to some extent. But if you look at Indonesian mines, it's a pretty simple business and operation. These are open cast mines. There is no deep dive digging. So the automatization to some extent, maybe in the supply chain, to bring the coal to the port, to track the trucks, etc. But it's still a relatively unsophisticated, I would say, operation, and to a large extent still relies mainly on manpower. Australia is a bit different because the wages are very high, and then they have to pay very high salaries to get miners. But if you look at China, if you look at India, if you look at Indonesia, coal mining is actually a way to keep people employed. And that's why they want to keep, to some extent, the coal production. So moving to full automation and having to make many people redundant is a bit more, I would say, in these countries at least, probably more challenging. But so back to Ira's question, I think in a business as usual scenario, when the coal industry is making money, when the gas industry is making money, given my slides, I think the main competitor for coal is renewables, wind and solar in particular. Because that's the cheapest and the most available in these countries. And that's where we have seen so far, at least, the biggest investment. But when we come into a different scenario where the coal supply chain is getting stretched economically and many coal mines start to lose money, then that's where we could see an acceleration potentially in the closure of mines. I just read a report today. Indonesia has announced that they tend to cap their coal production at 600 million ton next year, this year, 2026. So, I mean, we always have to be careful because things tend to change, but it would be one of the first year where Indonesian production would be flat or even potentially lower year on year. Again, fueling the argument that there is not a lot of additional capacity in terms of coal production coming. So if we are in non-normal circumstances, which is very or falling power gas prices pushing the coal mines below the cost of production, then because the renewable capacity and generation is still somewhat limited, assuming the power demand remains stable or even increases because of a fall in fuel prices, and which will fuel economic growth, you could see, at least in this short period where some of the coal mines are phased out, you could see some coal to gas switching. But this could disappear again, once the market and prices start to rebalance. But there is a potential for short-term increase in gas market share in some of these countries if we start really to see cuts in coal production.
Thank you. Fantastic. Okay, we have 3 questions here. I would love for Tony, Matt, and Peter to all ask their questions, and then we can, or the comments that you have to make, and then we'll sort of take it from there. So Tony, you first, Matt second, and Peter third.
Great, thanks, Ira, and this fascinating discussion. Thank you very much. So, more comments, but perhaps the panelists can weigh in on whether those comments or perception from myself is actually correct. So, one is that the coal to chemicals in China probably it will stick, and probably gas won't be substituting because it is a domestic source. And gas is being viewed as a imported source, so that's probably the stick. And second is that in terms of level of coal prices, if you lose Newcastle coal at I agree with Guillaume that $100, 90 to $100 per ton is probably a strong support, and that will be equivalent through the power generation conversion. Level will be $6 per MBTU gas. And that's why ourselves and maybe, some other banks have talked about this $6 level. But then seeing what happened in the US in terms of promoting coal to gas switching, probably gas prices need to go way below that level to promote switching. But what we observe sitting in Asia is that there's probably no switching Korea, no switching Taiwan, maybe some switching Japan, maybe some switching China, but it's black box, and some kind of refining as well as on the naphtha and propane side, switching in India, but the volume is so small. So that's why we wonder, what if gas prices need to collapse to, this kind of, long dated 2028 beyond $6 range. And then finally is from the coal and jumping right to renewables, our understanding is that some corporates, because of their own, and these are really large corporates, use a lot of energy because of their own environmental policy objective, they're actually skipping gas and go right from coal to renewables in terms of the electricity offtake. So those are, some of what we think is happening in the market, but please correct me if I'm wrong. Thank you.
Thanks, Tony. I'm sensing the same thing about the skipping thing as well. Matt?
Just really one comment and one question for the group. I mean, first comment, I think we had another comment about Permian growth decelerating. We're big players in the Permian. We don't see that. We've got plenty of growth coming. We haven't even started touching the deeper gassier benches. So I think counting out Permian gas growth as a contributor, I think would be a substantial mistake. The question I have is more a nuance or commercial one as we try and accommodate the growing US supply. Obviously, we've got really a bifurcated market of US Henry Hub, and we've got Brent-based legacy contracts. And I just wondered, with the contract roll-off that you pointed out, I think the other day, Ira, growing into the 2030s, how does the group think about the interplay of, a situation where Goldman just the other day was saying they see 70 and higher Brent, which would on a 13% slope would be a $9 gas price versus a Henry Hub link price. How does that interplay in terms of how that supply surplus is absorbed by the buyers? If that's a relevant question. If it's not, tell me I'm not.
No, very relevant question, and I hope we have enough time to answer it here, but I wanted to get Peter's comment in and then Costanza right after that.
Yeah, hey. Mine is more a question on Qatar, really as a follow-up to what you and Anne-Sophie wrote about in September. You wrote about their options all the way from active market management to aggressively going after market share. There is a lot of discussion in the market on where Henry Hub needs to be late in the decade. What is needed to get producers the returns they want to meet that incremental coal and supply for exports and combined cycles. Does the outcome there change the probability of what strategy Qatar will choose? So if Henry Hub rallies, does that convince Qatar they can exert some pricing power through idling uncontracted capacity without increasing the risk of more US FIDs? Once they have more confidence on what that long-term supply stack, not short-term curtailments, just the long-term stack looks like, could they take more of a Saudi-like role and try and keep price at the optimal level for them?
Great. Thank you, Peter. Costanza, do you still have a question or you no longer have one or comment? Okay. Anne-Sophie, I'm gonna let you tackle that question in terms of the Qataris, and I also wanted to hear if you could make a comment on the EU's role here, because it seems like the EU has an outsized role on both the supply and demand side here going forward. in terms of whether they're going to whether and how much Russian gas could potentially be allowed back into the market. Even though and despite what they're saying about ending Russian gas after a certain period of time in the next few years, they seem to have a potentially very big swing role in a market that, frankly, as you said, is losing industrial gas demand, and its role is largely as a storage player for 6 or 7 months a year for gas that's going to be consumed in other markets. But let's start off with the Qatari question first, and then maybe talk a little bit about the EU, and then Matt, I'll come back to you about your question as well.
Thank you. I think one of the decisive questions about Qatar is whether they will actually give more flexibility to the buyers. This is what buyers want. I mean, when I am talking to several buyers, this is a big
And Sophie, you're a little soft there. It's a little louder if you could. We're having trouble hearing you.
Okay, can you hear me better?
A little bit.
Okay, sorry, I haven't changed anything. Yes, so I mean, I think the decisive thing regarding Qatari LNG is, well, there is a pricing question, but there is also the flexibility. And one of the big differences between the Qatari contract and the US LNG contract is really this question of flexibility. This is what buyers want right now. If you talk to Japanese, if you talk to many buyers, they want to be able to divert the LNG as they wish. And this is one critical thing. Otherwise, I mean, as we have shown in our report, I mean, Qatar is going to be the last man standing. So if they absolutely want to undercut US LNG, I mean, they can, but do they want to? And this is a key question. I mean, if they want to basically bring $4, $5, $6 per MMBTU LNG to Asia, yes, they can. Well, and it's a question of margin. It's a question of, do you want to do that? I was in Doha last month. The Qataris were notably absent from the roundtable, which was organized by Georgetown University. So it's a little bit business as usual. They don't talk to anybody, and it's extremely difficult to get any insights on what they really want to do. So I guess we will have to wait and see until the first LNG from the North Field expansion is going to appear on the market. EU, I mean, yes, EU is an interesting market, is very uncertain. And as I mentioned, I mean, I think it's going to be structurally declining in terms of gas demand, but with so many hiccups, that this is going to be complicated for both buyers and sellers to actually predict what could happen. Because how do you predict, potential issues with hydro, with renewables, Dunkelflaute, with nuclear, as well as cold weather? So this can be actually creating a lot of swings for demand from one year to another. On Russian gas, we have few people from the European Commission here. So the plan is that by the end of 2027, there won't be any more Russian pipeline gas. Of course, there will be a few countries which are going to resist that, namely Slovakia and Hungary. But whether Russian gas will meaningfully come back to Europe, I have doubts. I think we are too far gone. This is exactly what I was saying this morning at the Gulf Intelligence conference. We are too far gone in terms of trust between Europeans and Russia. I mean, they have been testing our defense with drones, with planes, etc. I think we don't really want to trust Russia anymore. So this is where we are. Now, I would also point to the report that Tatiana and I have written just before Christmas, the EU in a petrostate and electrostate world. Well, Europe is in a very uncomfortable in-between, where it's kind of bullied by petrostates, including the United States, but not only, and also the electrostate, which is China. So the key question strategically is how Europe wants to evolve in order to reduce its dependency on petrostates while also not becoming strategically vulnerable vis-a-vis the electrostate, which is China.
Thanks, Anne-Sophie. And just it's 10:30 here, so we're gonna wrap it up soon here. But I wanted to get back to Matt's question because I think it's a really important one. Is that in the oil price scenario, Matt, that you laid out, you're talking about a $9 oil index contract world, whereas in Mike's world, where in the Oxford scenario world, he's talking about $6 gas, and having those two things operating in the same world at the same time, $9 gas and $6 gas, certainly has implications for overall LNG demand going forward. So I think a couple of things are going to definitely happen, Matt. One is, I think, if on a sustainable basis, oil index prices stay in that $9 to $10 range, when reopeners emerge in terms of those contracts, we're going to see the reopeners change the structure and the slope of those contracts, because in that kind of world where you perpetually have $6 spot gas potentially in the world, let's say at JKM and TTF, that seems to me sort of an incompatible scenario between having those two types of prices at the same time. And that also sort of leads to the other issue, which, you know, a lot of Andrew's customers and a lot of other US LNG customers and customers around the world are buyers who are going to need to resell their gas. Again, in 2025, 40% of the contracts that were signed, and it was a record year for LNG contracts being signed, so they're not quite gone and buried yet, were with aggregators or portfolio players. So the resale market and the size of the resale market is going to be immense and unprecedented. And I think in that way, compared to the first wave and the second wave of LNG, when, you know, structurally the market was really based on the central tendency price being an oil indexed long-term contract, and the spot price was going to move around that price going forward. I don't see that world in the future, because I think, I mean, and I think this is a conservative estimate by me, that 40 to 50% of the entire LNG market is going to be trading on a spot basis actively on a daily basis. And I think that does change the relationship between this oil indexed contract price that we've talked about, you know, for the past 50 years, and then the spot price that is going to emerge as a price going forward. Not to mention the difference between the spot LNG price and the domestic gas prices, or the gas prices that are TTF Henry Hub. So the difference between what the waterborne LNG price is and these prices such as Henry Hub and TTF are also another really important area that we certainly plan to explore at CDEPT in the papers and the work that we're doing going forward. So I think we're going to wrap up this session now because we're going to take a break. The next session is going to start promptly at 10:45 or at quarter to the hour, depending on where you are in the world. I'd like to thank all of our panelists, Andrew, Anne-Sophie, and Guillaume, for their comments, and everyone else's comments. And I look forward to everyone coming back for the second session in approximately 10 minutes. I will talk to you soon. Thank you.
Hello, Maria.
Hello again.
Hello,
Bonsoir.
Vanessa. Bonsoir. Indeed. This is great. We have 50% ladies in terms of the panelists, so I think we are doing extremely well. No, Vanessa, it's quite complicated to get enough women in this industry, so I'm very pleased, indeed.
Well,
And
you did
very
a
nice
great
meeting
job.
you. Thank you. Okay, I see people are starting coming back, but I want to make sure that Ben is here, so okay, that's good. I mean, we are going to give people another 1 or 2 minutes. Okay, let us start this second session, which is going to be about the implications of the EU Methane Regulation for LNG buyers and suppliers. I'm very happy to welcome our 3 panelists. So first of all, Maria Olsak, who is a research fellow at the Oxford Institute for Energy Studies, Vanessa Ryan, who is a general manager at Chevron. I think somebody is not on mute. General Manager, Climate and Engagement at Chevron. And finally, Ben Cahill, who is Director for Energy Markets and Policy at the Center for Energy and Environmental Systems Analysis at the University of Texas at Austin. So you might know them. They are really great experts in terms of everything around methane emission. And I know that we have also been joined by a few people that I know are very much experts on methane emissions, including my very good friend Jonathan Stern, who has apparently escaped grandchildren duty. So that's good to have you as well. But without waiting too much, I really want to start this session because the EU Methane Regulation, which entered into force in August last year, has actually created a lot of questions as soon as it was passed, and especially because it's not only impacting the very limited fossil fuel production that we have in Europe, but it's also impacting imports. And if anything, the discussion has been extremely tense on LNG imports, especially over the past few months with the US administration. So on top of having something which is technical and contractual about how exactly companies can actually meet these EU requirements, there is also now a geopolitical angle. But without waiting too much, I'm first going to give the floor to Maria, who is going to explain a little bit more about this EU methane regulation, just in case people don't know everything about it.
Thank you very much, Anne-Sophie, and thank you very much for having me today. I'm really happy to share the panel with Ben and Vanessa. I must say that presenting the whole regulation in 7 to 8 minutes, it's a little bit challenging, even for people speaking so fast. But I think I will focus just on 3 questions instead. So the first question is, what is the regulatory intent behind the EU Methane Regulation, and more specifically, the importer requirements? The second question is, how does the EU seek to regulate emissions over which it has no legal jurisdiction? And the last question is, how are the LNG buyers responding to these new requirements? So going back to the first question, in order to address it, we need to look at the very first article of the regulation, which specifies that the regulation lays down the rules for more accurate measurement, reporting and verification of energy-related methane emissions in the EU, and also some provisions around mitigation of those emissions, for instance, by introducing provisions on and restrictions on venting and flaring. There is also another sentence in this article that specifies that another objective is to enhance transparency on methane emissions. What you won't find in Article 1 is any mention of the import standard or any efforts on the reduction of global methane emissions. The reason for that is that this methane intensity import standard was never part of the EU Commission original proposal for methane regulation. It has been added at a later stage during the legislative procedure at the request of European Parliament, and it was backed by some of the member states. I actually talked with an assistant working with one of the MEPs that negotiated this legislation, and she told me that she's never seen in her life a legislative act to be changed as dramatically as Chapter 5 of EU Methane Regulation targeting the imported emissions. The reason why I'm mentioning it is that I think it helps us to understand that I would say it's better to see methane regulation and the import standard as a policy that sets the general direction of travel. But I think when it comes to the details and exactly the how to do that, that will be specified through practice and also through secondary legislation. And that brings me to the second question. So European Commission employs quite a lot of lawyers, so I think it should be no surprise that the target of the regulation is actually private supply contracts, with EU buyers being directly responsible under the regulation. EU buyers are companies that place gas on the EU market, and it means that there is no direct legal obligation on the producers and exporters in the third countries. I also want to emphasize that the focus of the import standard is on production level only, so it doesn't cover the full supply chain. That's what is in the regulation. But of course, in order to comply with it, EU buyers need to rely on what actually the producers will provide in terms of information and also mitigation efforts. So I think the challenge here is now for the EU buyers to actually translate these legal obligations from the regulation into private supply contracts. And they need to do, they don't need to do everything overnight. It will be a very gradual process, but the requirements of the regulation will be over time more and more challenging. So the first step is actually starts in May 2025, when we had the first deadline to provide information to the competent authorities on the producers. So it's actually not that controversial in terms of what type of information needs to be provided. And it's relatively easy exercise if you have a direct contractual relationship with a producer, but becomes much more challenging if you deal with more complex supply chain. So that was the first step. The second step kicks in as of 1st of January 2027, so less than 1 year from now. And here the EU buyers will need to provide emission reports coming from the producers based on measurements instead of just using standard emission factors, with methodology clearly explained, and also all the documentation needs to be verified by third-party verifiers. And in the last step, they would need to demonstrate that the methane intensity of the producers stays below the level that, again, will be defined by the European Commission at a later stage. And this requirement enters into force as of 2030. So as you can see, this is a very gradual process. I think one thing that we need to keep in mind is that the firm requirement is only for contracts that will be signed or renewed after the 5th of August 2030 for the methane intensity standard. So again, that gives at least the companies a little bit more time to think how to comply with the regulation. Now, when it comes to the last question, So if methane regulation becomes fully implemented, so what the EU standard means for the EU buyers is that they will need to introduce this additional factor, which is the documentation and also the methane intensity at the producer level in their purchasing decisions. So I think that's definitely a new element, and that creates a little bit of an additional risk for them. One thing that I wanted to mention is that the EU industry is definitely divided on the issue, with some companies trying for a number of times to revise the regulation. Others try to change just a little bit. And some companies actually, but more in private conversations, seem to be relatively happy with methane regulation. What is happening in the short term and what the EU buyers are trying to do right now, I think, is to ensure that the risk that comes with methane regulation is shifted to the producers and exporters. And of course, the producers and exporters do not want to assume this risk. So that's why we've heard about a couple of instances in which the parties left the negotiating table without reaching a compromise on the contractual provisions, and only because of the methane regulation. I think what will happen in the longer term, and again, if methane regulation is fully implemented, is that methane regulation will transform methane intensity, which is currently just climate change metrics used very widely in academia, into a commercial one, with all these implications for how the supply, how Europe will actually source the gas in the future. What it means for the producers, I would say it's quite obvious. So first of all, that low methane intensity becomes a market access issue. And I would say that they have a simple choice between either adjusting to these new requirements or trying to find the gas buyers outside of Europe. But apparently there is a third way that is considered by some producers, is to try to convince the European Commission to actually apply the EU methane regulation to some of the producers, but not actually to them. I'm looking forward to the comments from Ben and Vanessa, as I think they will provide a little bit of nuance here. So thank you so much.
Thank you so much. Yes, everybody, but not me. This is the conclusion. Okay, I will definitely have a few questions on what you have just mentioned, but now turning to Ben, because I also know that he has been recently publishing with his institute some papers on and some visibility on what could potentially happen with this EU methane regulation. Ben, the floor is yours.
Okay, thanks, Anne-Sophie. Great to be here and great to be on the panel with Maria, who I've learned a lot from over the years. She knows this regulation inside and out. And also with Vanessa, who's been a real leader in methane mitigation at Chevron and really in the whole industry. So I thought what I could try to do briefly is provide some background and some market and political context for where we are with the regulation, and then zoom in on 4 specific areas where I think we probably need a little bit more clarity. So as Maria just mentioned, I mean, the essential feature of this regulation is that it's a multi-year phased-in process. It kicked off last year when the regulation came into force, but a lot of really critical elements will remain uncertain for some time, and the entire regulation won't be finalized until 2030. That's the timeline that's been laid out. So a lot of this has to be completed through so-called secondary legislation, future implementing acts and delegated acts and EU speak. But much of it is still open to interpretation, and I think requires more guidance, and this is where things are problematic. To be frank, I think that this process is kind of familiar for EU-based companies that are used to EU regulations. They're familiar with the process, but it's quite confusing for global gas suppliers, especially those in the United States. At our event at the University of Texas, we had a speaker from the EU delegation to the US a while back, and he used the term constructive ambiguity to describe the EU regulatory process, which I think indicates that it's normal for EU regulations to have this kind of evolution so that there's a learning process. But if you're a compliance officer in a company that's trying to sign contracts, constructive ambiguity is not so helpful. So basically, for more than a year, there's been a kind of standoff, as I see it. Companies want more clarity from the European Commission. The Commission really wants the industry to propose technical solutions and say, tell us how you can do this, and we'll determine, if it works or not. And the Commission also notes that the member states of the EU are really responsible for implementation. They're also responsible for enforcement and penalties. And so the Commission can't overstep its legal bounds. It has to be quite careful about that, and it's communicated that to companies. So to be frank, this is a frustrating period for the industry. It kind of reminds me of that meme where you have the three Spider-Men, people in the Spider-Man costumes all pointing fingers at each other. And we frankly haven't really had that much more clarity in the last year. And it was mentioned earlier in Jason's opening comments, but I think the market and geopolitical context is really important here and how this plays out. The EU is committed to phase out Russian gas by 2027. Dependence on US LNG is already high and it's rising. Last year, 57% of LNG imports into the EU, 27 countries, came from the United States, and that's rising quickly. And we have the US-EU trade agreement that includes a pretty lofty goal for trade, energy trade between the US and EU. The annual target is $250 billion in energy trade. Now, I think in 2024, total energy trade between the US and EU is about 70 billion. So you can ask yourself if that's feasible. But the Trump administration is viewing all this partly through the lens of that EU-US trade agreement. And any extraterritorial regulation is being viewed as a hindrance or an obstacle to meeting the EU-US trade agreement. That's the lens in which the Trump administration is viewing this. And frankly, I think that in Europe, it's important to remember that some policymakers have a concern. Some people are concerned that their trading dependence on Russian gas or overdependence on the United States. And when they see some of the demands being placed on the EU related to this regulation and others, it makes them a bit nervous. So all that background, I think, is really important. So as Maria mentioned, we're 1 year out from a key deadline. And this is the January 1st, 2027 deadline for MRV equivalents. Basically, that means any gas buyer who's placing gas onto the EU market has to prove that it was produced under MRV conditions that are equivalent to the rules that apply in the EU. And that's a big challenge. So right now I see 4 areas that require more clarity. Traceability, or acceptable systems for reporting producer level emissions. Verification, all this data has to be verified by a third party to meet that MRV equivalence requirement. Penalties. What's the likelihood of penalties in the case of good faith reporting efforts? And the penalty issue is one that often gets brought up, and it's quite significant. And then reporting timelines. I think this is not as significant, but there is some confusion about what's due in 2027. So I'll probably focus a bit more on the issue of traceability. And what I mean by that is, what is the acceptable system to report producer level emissions? And basically, several systems have been proposed. And they were considered by the Energy Council in December. There was a meeting on December 15th in Brussels where the member states came together and considered this question. Basically, there are 3 different systems that you can consider: book and claim at a national level. And this means that production assets anywhere in a certain country can undergo MRV, generate certificates or environmental attributes. Those attributes are decoupled from the physical volumes. So it's not about attaching a certificate to specific gas volumes. Just means you have to buy a certificate from within a certain region. That's national book and claim. Second option is regional book and claim. It's essentially the same system, except the MRV characteristics have to be for gas produced within a certain basin. So for example, if you are doing this at a basin level in the United States, this means you can't use a certificate from Appalachian Basin gas. It has to be for Permian Basin gas. So the certificates have to be sourced from the same basin as the feed gas supply. This does not imply that you have to track all the molecules for a certain LNG cargo, for example, but it does mean that you have to prove the origin of the gas down to the basin or regional level. The third option that's been proposed is what's called trace and claim. And basically means that you have to demonstrate MRV for relevant production assets, but you also have to define the entire supply chain from the producing asset level to the point of sales. So you have to document and verify the emissions as the gas flows through the system. And obviously this is complex in any country around the world. This is especially complex in the United States. We have gas value chains that involve LNG sellers, producers, midstream companies. An LNG seller often has no equity stake at all in the upstream sector, certainly not in the midstream sector. So gathering this data is complicated. My colleagues and I published a paper, a white paper in December, and it modeled the emissions impact of all these different systems. Ultimately, that's what this is all about, right? It's supposed to be about reducing emissions. So what is the emissions impact of adopting these different systems in the United States? And in short, we found that national book and claim would have no emissions impact. And the reason for that is that if you have a national book and claim system, what that does in the United States is creates very strong incentives for certificates, but a large share of those certificates would be for gas produced in the Appalachian Basin. And as many of you know, this is some of the lowest emissions intensity gas in the world. About half of the certificates from MIQ, the certification agency, come from Appalachian Basin gas. So basically, you'd have booming demand for those certificates, but really no linkage between the supply of certificates and emissions mitigation in the Haynesville Basin or the Permian. And that's significant because as far as we can understand, or we've estimated, only about 15% of gas flows to the Gulf Coast region come from Appalachia. The rest is from the Permian and the Haynesville. So limited mitigation impact. At the opposite end of the spectrum, you have trace and claim, more complex, more administratively difficult, certainly hard to pull off in the United States as well as in other countries around the world. It is technically feasible, but it's a lot more complex. And there, frankly, the methane mitigation potential will be greater. So what has to happen next? The member states have to decide what's acceptable, and they're leaning on the European Commission to provide technical guidance. And this is essentially what they decided at that Energy Council meeting last month. All the 27 member states have what's called a competent authority. The competent authority is usually a ministry. They're responsible for implementation at the national level. As I mentioned, they're also responsible for penalties. So they ultimately have to decide what's acceptable, but they need a good steer from the Commission. And so what they said is, look, there could be different systems that are acceptable. Maybe it's certification, maybe it's book and claim. Both can be acceptable, but we need a little bit more technical guidance. The challenge, as I see it, is that we only have a year to figure this out. And companies really need to know what to do, and they need stronger signals soon. So I think waiting is creating some real challenges for global gas suppliers in the United States and elsewhere. I've been thinking about other issues around verification, penalties, reporting timelines. I think that there are opportunities to provide clarity on each. I'm probably running out of time in these opening comments, but maybe I'll just put that aside for now and we can talk about it in the Q&A. Thank you.
And thank you very much for, shedding some light on something which is very, very, very complicated. I think everybody who is working on methane emissions know that this is very complex issues and it involves so many things. And also thank you for putting that in a more geopolitical context, because we have seen that yes, this is happening within the framework that the EU has accepted an aspirational goal of $250 billion of fossil fuel imports from the United States, or energy imports from the United States, which is really aspirational. But indeed, the United States is coming back with saying, well, actually, you should do that, but you are not able to, because there is no way we have reached this level in 2025. So why don't you give us a little bit more, or you forget about this legislation for a few years? And I think the US in late December also said, well, why don't you give us exemptions until 2035, which would probably weaken the EU Methane Regulation quite a bit. Now turning to Vanessa, who is going to give us your perspective from a producer.
Well, thank you very much for having me on, Sophie. And Ben and Maria did a fabulous job sort of laying out some of the aspects of the rule and some of the uncertainty. As a producer, the uncertainty almost paralyzes your ability to make the kinds of decisions that we think the EU actually wants us to make. This is a fascinating experiment in very aspirational policymaking and how the rubber hits the road. But what I wanted to start with is that I think our company and I would venture most leading companies in the U.S. share the aspiration that methane should be reduced and that producers that make those investments should be rewarded for that. So in terms of aspirational alignment, I think it's actually quite high between producers and the EU in this space. I have the real pleasure of representing Chevron in several voluntary initiatives in the methane space, including the Oil and Gas Climate Initiative, and the environmental partnership, which is US producers. And the number of people showing up to share what they're doing, what they're learning from, has not declined in the least in the change in US administration and the change in global pragmatism in the energy space. Methane is an area that I continue to see get a lot of energy. I see technologies evolve greatly when I think about what we had available in our toolbox when I started working on methane for Chevron in 2012. Versus what, I can send a text message and get a plane over an asset in the Permian probably tomorrow that can give us data that is incredibly impressive. That was not an option 10 years ago. That was not even really an option 5 years ago. So this is an area where industry, academia, the service companies, and I mean the service companies broadly. I'm not just talking about Halliburton. I'm talking about the general ecosystem that is working in this space continues to grow and advance. But where this particular regulation poses a lot of challenges for operators, Ben laid out some great categories. I'm going to add one, but there is a fundamental. I think somewhat of a fundamental misunderstanding of what methane measurement is and what it isn't today. While we have made phenomenal advances, what you get from a methane measurement is not the same level that you get from financial accounting. It's not as accurate as a ruler measuring the size of a computer, right? These are measurements where each individual measurement generally has a significant error bar, add on temporal variability, add on geographic variability, add on coverage, and you're putting layer upon layer upon layer of error onto a measurement. The measurements are still exceedingly valuable, but when you talk about making a financial decision based on data where you can get the data to say a lot of different things based on how you choose to apply that error, it's frankly a little bit scary to think about how easily this system could be manipulated based on the state of science and detection and measurement today, coupled with the fact that the EU has not yet indicated what sort of measurement verification system would be acceptable. It's very unclear as to what operators should be doing right now to get ready for, as Maria aptly stated, we are now less than a year out. So it's difficult to make decisions, right? It's difficult for me to go to one of my operations and say, you should go get this technology and get it ready by this date because we're going to have this verifier come in. I don't know any of those things. I can't tell them with any level of certainty that if we pick a certain measurement technology, it will be okay. Or if we use a certain verification reconciliation methodology, that it will be allowed. And we're less than a year out. So you start to think about how that contractually embeds down the value chain. It's a real challenge for operators and a real challenge, I think, for importers, though that's not a category where we play extensively. And then, Ben, I just wanted to add to your list of uncertainty, one that I don't think gets talked about a lot. And I know this is a gas forum, so maybe of less interest, but oil. So, there are some methodologies out there for measuring methane from gas that don't apply particularly well to oil. And then in most cases, you're producing gas with oil in some ratio. And how you allocate the methane emissions between the various products and what intensities might be allowed for the various products is something that I have seen very little discussion upon. But, when Ben talked about the issue with most of the certified gas being in the Marcellus and the Haynesville, for those of you that are not super familiar with US basins, those are dry gas basins. They require very little processing and there's no oil and very little liquids that are produced out of those basins. So part of the reason they're very low methane emissions is just inherent in the fact that they're dry gas and requires very little processing. So if the aim of the EU methane rule is to reduce overall global emissions produced by importers, the easiest play would just be to send all the dry gas in the world to the EU but it doesn't actually reduce emissions. And then the EU is also applying this rule to oil. And so we don't really know how oil will be, the MRV standard for oil is even further behind than that for gas, and not something that has been extensively discussed by the policy community thus far. So I'm going to close with that because I think I'd love to hear more from my fellow panelists and any questions from the audience.
Thank you very much, Vanessa. I think it's always great to get the opinion from somebody on the ground, and I love everything that you have said on especially the methane measurement and the fact that, yes, we are getting better data, but you still have a lot of uncertainty because, I mean, you know, it's also illustrates the kind of challenges that the industry is facing. Well, I don't see any hands raised, so I would like to, okay, Andreas has just raised his hand. So I'm going to give you the floor, Andreas, and it would be really fantastic if you could appear on the screen. Yes, this is now done. For those who don't know, Andreas is the Secretary General of Eurogas in Brussels. So Andreas, the floor is yours.
Thanks, Anne-Sophie, and thanks indeed to all of you for the great introductions. This is a topic that is obviously very dear to me since we're representing European importers. I have especially one question, but before I get to my question, there's one comment I'd like to make to Ben, and perhaps something that is worth specifying in your presentation. I think you might be right when it comes to the kind of incentive you create with the national book and claim system in the United States. But I think it's worthwhile specifying that this applies to the United States, and with a national book and claim system approach applied to other countries, you would indeed still have quite significant environmental incentives and compliance incentives for other parts of the world. So that's just a minor comment. Happy to hear your view on that. A question I would have to all of you is, and it links to something that actually Anne-Sophie had mentioned in the very beginning. Most of the gas is contracted by aggregators, traders, right? And gas that has been contracted prior to August 2024, it's probably not accurate to say is exempt, but there you have to demonstrate best available efforts to bring those contracts into line. So for simplicity, I'll say that those contracts are exempt. Now, that begs the question, do you see that there's a risk for market concentration? Because those contracts are exempt if you are also the European importer. So an integrated company that might face less challenges, and a European midstreamer who will have to source some of that gas will find it very challenging, potentially, since the primary contract holder might not have the same kind of incentives to bring those contracts into line. Into compliance with the EU Methane Regulation. So I'd be curious to hear your views about that. And thanks a lot for the great initiative, great event.
Maria, Ben, Vanessa, anybody who wants to answer that question?
Sure, I can make some brief comments. So, Andreas, thanks for the question. I think you're right that the United States faces maybe some particular challenges because we have complex gas supply chains in this country. And frankly, in other places, it shouldn't be as hard to comply. I mean, in Qatar, for example, you have one company that has a presence throughout the value chain, from production to shipping, shorter distances, much simpler supply chains. Qatar Energy has already joined OGMP 2.0. Using OGMP 2.0 level 5 is one way to reach that MRV equivalence. To satisfy the requirement if you get all your data verified. But it's pretty important to figure this out for the US and for other countries with complex gas supply chains. It's not just the US. Think of a place like Nigeria, for example. We have different levels of companies and equity partnerships in the upstream and in gas gathering, offshore platforms, and in LNG. On the question about market concentration, I mean, one thing to keep in mind is that when the regulation was designed, my understanding was one of the principal goals was to gather data on the emissions intensity of all the gas that the EU buys, to create more transparency and clarity, and to be able to compare and contrast the emissions intensity of all the sources of gas supply. I think implicit was that if the EU had all this data available to the member states, they could make informed decisions about how they could best drive down emissions by buying so-called cleaner gas. The reality is that some countries and some companies are going to be better positioned to meet these requirements than others. In the United States, this is complicated to do, but we have a lot of companies like Vanessa's and like Cheniere that have invested a lot of time and money in methane monitoring and measurement. We have this huge ecosystem of service companies and academia and others that have been working on this problem for years. So we have a huge head start if there is clarity on what's required. And the global context is important. You have a lot of global gas suppliers who are really at stage one, and it's going to be extremely difficult for them to meet these requirements, especially if the EU chooses something like a trace and claim system. I mean, we'd have to stand that up in short order and expect a lot of these market participants to comply. And I think that would be pretty hard. My last comment on this would be, just to reiterate, it's supposed to be a multi-year phased-in process. I think if you're familiar with EU regulations, it seems unlikely that steep penalties will be applied in the early years and that the most stringent application of penalties will happen in the early years while we're getting this off the ground and figuring out how it works. But again, I would just say, if you're a compliance officer, if you're trying to go out and sign supply contracts, it is a problem. The risk of penalties of up to 20% turnover are a huge problem. The risk of potential loss of market access is an issue. And so I think that the regulation was passed without fully absorbing some of the immediate challenges that this would create for market participants.
Okay, Andreas, just
because I realize I might not have been entirely clear. So what I was trying to get to is the fact that if you have a contract that is signed before the entry into force of this regulation, your contract should be, let's say, exempt. Now, it is only exempt if you are also the importer of that molecule. If you are, so for a portfolio player, right, if you're also the importer, but if you want to sell that gas onwards to a European importer, that gas is then becoming within the scope of the regulation, given that it is thereby a new contract. So the original source of that contract is exempt, whereas the midstreamer will find himself having to comply with a relation with the primary contract holder might not have the same incentive. That's what I was trying to get at. And that could create some form of distortion as well on the global market. And perhaps also with linking to the previous discussion, looking at the future attractiveness of the European market, will those companies have sufficient incentives to bring those contracts into compliance? Or will they say, well, I'll bet on other growth markets where it might be easier to sell my gas? Sorry if that wasn't entirely clear from my initial comment.
So Ben, Vanessa, or Maria, do you want to follow up on that?
Maybe just, if I may, a very quick comment. Andreas, I think, yeah, you made very interesting points, but I'm not that concerned about that at all. I would say the only potential concentration that can happen is with Norway because of very low emissions and the fact that potentially they could get country level equivalence, but they are supply constrained. So it's not, let's say, an issue that all, it's kind of joke, but I would say I don't share this concern about concentration.
Thank you. I see that Tim, or I don't know, Tim and friends have their hands up. I don't know.
Yeah, thanks a lot, Anso. And indeed, you're right. It's not me, but I'm going to ask Laszlo. Do you want to have a go?
Yeah. So
you have joined the IEA again?
Yes, start a new year with nostalgia. Anyway, so two questions. One is that in my experience, I mean, Brussels is not Houston. So the number of people in the city of Brussels who have in-depth expertise about the American oil and gas industry is not unlimited, and not all of them are employed by the European Commission. In your experience, to what extent this regulatory drive really understands the American oil and gas industry? And is there a risk of unintended consequences from this? So that would be one question. The second is that the irony of the Brexit decade, that during the Brexit decade, the UK became actually much more deeply integrated into European energy infrastructure than it ever was as an EU member. And under certain market conditions, the UK is actually acting as a gateway of LNG, with LNG arriving in UK LNG terminals, and then it becomes part of the UK's liquid and well-functioning gas wholesale market, and the interconnectors push gas into the continent. And given that the UK government is currently not implementing this type of methane regulation, how this will work in terms of the UK-EU as energy market integration?
And
And I
Sophie,
think
if
I
you
can
allow,
extend that. Yes, yeah, okay.
sorry,
And
just
I
because,
just want to say I can extend the question to Turkey, because Turkey is also having their own Turkish blend, which is going to arrive somehow to Europe, which is going to create a lot of issues. But yes, sorry.
sorry, Anne-Sophie, just because we are in the same room and we have the floor. It was a general comment and then a question, because I mean, all speakers have kind of flagged the uncertainty that there is in measurement of methane, and that it's not, we're never going to be as definite about what methane emission levels are as financial statements, for example. But I mean, the EU regulation, as I understand it, isn't asking for that level of certainty. It's asking for the same as what is applied currently in the EU, or OGMP level 5. And so there is a high degree of I would say clarity there as to what OGMP level 5 requires, and it doesn't require that you have zero uncertainty. That it requires that you have fulfilled the requirements. And so I don't think that in of itself should be a reason why we should be pushing back on the regulation. But the question I would have is, there is still some uncertainty in OGMP level 5, and it kind of falls on the people who are in charge of OGMP to decide as to whether something is at level 5 or not. And does that mean that IMEO and UNEP therefore have a very kind of strong hand in how companies will be perceived as to whether they are in alignment or not? And is OGMP and the people working on it, are they aware that they have this level of power? I mean, we talk about 20% of revenues as a penalty. I mean, that's a pretty major financial stake that is therefore in their hands.
Can I just clarify real quickly, and maybe Maria is the expert, so maybe it should be her, not me, but the OGMP itself is not enough. So you can't just achieve level 5 and call compliance. You actually have independent third-party verification, which has been clarified by the EU as not OGMP IMEO staff. So where the uncertainty comes in is that verifiers have no verification protocol. So OGMP 2.0 has, I don't know, you could probably count thousands of permutations of how you could calculate the number. And one of the ways that is allowed under OGMP is you pick a technology with a very large error bar. And the larger your error bar, the more likely you're to fit the two error bars together, right? That is acceptable in a level 5 approved method under OGMP 2.0. We're not sure that a third-party verifier, a Ernst & Young or a KPMG, would be comfortable putting their name to that. We haven't found any that are willing to come forward and say, hey, we're open for business and we'll do this level of verification without a protocol. So I think that's where the real uncertainty comes in that you need to get a third-party verifier to verify your level 5. So some of the inherent flexibility that OGMP developed for very important reasons, right? Because they wanted to bring as many people to the table, becomes a challenge when you need that third-party certification for the EU methane rule.
Yeah, that's a really important point. Can I just jump in here? So the regulation in Article 28 gives a couple of different options for MRV equivalents. You can do OGMP level 5, as Vanessa just mentioned, or you can do what's called Article 12. Either way, you have to get your data independently verified by a third party. And it has to be done at reasonable assurance level. And if you're familiar with auditing terminology, getting reasonable assurance is quite complicated. It's an extensive process. It requires a lot of in-depth work by auditors. And what the regulation said is, well, you can apply OGMP 2.0 technical guidance documents to prove to a verifier that all the data you have is meeting the standard. You know, my colleagues worked on a verification protocol because we identified this big gap between what a verifier needs and what OGMP 2.0 technical guidance documents provide. According to the regulation itself, the requirements of the text, verifiers need more. They need a reporting protocol and they need a verification protocol. And the reporting protocol is where it gets quite complicated because it's basically the rules of the road in terms of what is required for reporting of all different types of assets in different operating contexts around the world. And so we published a draft protocol. We had a consultative process for a couple of months. We invited feedback from lots of companies, including those on the call today. The idea was basically to make this available to the member states, the commission and others, and say, okay, there's this gap that we've identified. Here's a protocol that could be used. Maybe it will get endorsed, I'm not sure. Maybe other bodies that have been identified with the EU will adopt something similar. But there's definitely this gap and it's quite significant. And there's a lot of support for OGMP 2.0 throughout the regulation. It's mentioned several times, not just in Article 28. But it's really important to note that OGMP 2.0 was not designed as a system to meet a regulatory requirement. It was really designed to transition companies to measurement. Each company sets a target and they identify a pathway to get to that target. That's what reaching level 5 is about. What the EU has done is create this regulatory requirement with reasonable assurance data requirement, and that's quite significant. I think this is one of the things that was introduced in the regulation without fully understanding how complex that would be for the industry to do. And so clarifying this is really important because, again, January 1st, 2027 is looming. For companies to put those pieces into place and to get the assurance that they need to meet the requirements, if we're going to do it by January 1st, 2027, we really ideally need clarity in the next 6 months on what needs to be done. So verification is a really critical part of the puzzle.
Anything you want to add on what has been said?
I can add just one thing to reply to the question on the impact on the UK. And I think the crucial thing to remember is that the import standard targets production level emissions only. When it comes to gas, UK is important transit country, but it's not, when it comes to gas, it's not important producing country anymore. But it will be important for oil exports into Europe. So I think that's where UK could be impacted, but not really from the gas side. I talked with a couple of UK-based market players. They were actually quite happy about Europeans putting on themselves additional requirements which do not apply to the UK. There were a couple of meetings between the European Union and the EU Commission and the UK government. So there is some form of dialogue going on. But my understanding, and if you look at the policy documents produced by the UK government, I think they prioritize security of supply. In the consultation document that was released last year, they mentioned something around so maybe there are some emissions associated with LNG, but this is like a flexible source of energy, and that's the most important. And I think the approach is also, when it comes to from regulatory point of view, is that to kind of show that they already did some measures around, especially mitigation of those emissions. That if you look at the North Sea Transition Authority reports, they show how low methane intensity they already have, and I think that will be the way to go. I think if you look at the history of relations between the post-Brexit relations between the EU and UK, there are far more important topics to discuss, I think, than methane regulation. So I would say that would be my comment.
Thank you. Andres, I saw you had your hand up. I was wondering whether you still had a question or whether your question...
No, it will be just a comment. Well, where we are where we are. So I think Ben rightly said, it is a typical EU legislative act where implementation is related with a lot of uncertainties. And usually you learn by doing. As I see the outcome of last Energy Council, member states are preoccupied but not extremely worried. So I would say that if I would be importer, I provided honestly information I have, and as the time goes, trying to get most out of it. And hopefully, by the meantime, Commission comes with more guidance, more courageous, because member states definitely would appreciate guidance, even if they will later criticize this guidance. I'm quite convinced, but that is how the situation is. And to be honest, now all these methane regulations that seemed, well, one of minor issues related in climate change issues now could be major issue. And in my opinion, for Europe to go to so-called omnibus procedure, it's basically giving up on climate ambitions, especially now when US is moving out on framework convention even. So it is a big political issue. I hope that nobody will escalate this issue, but let's try to do our best for whoever is involved in it. And at the end of the day, it will not be such a tragic consequences. There is a lot of uncertainties, true. There are, well, wishful thinking when adopting legislation, true, but it is there and basically drives the process where industry has invested already a lot. So it would be completely nonsensical to go backwards. And everybody who says something about regulation usually says, I support the goals. So it's my opinion, let's contribute to it and find workable solutions, even perhaps not so much directly related with letter of the regulation, but the spirit of regulation. And for me, I think the key issues that could improve everything is to focus on final part of this legislative act. It's a methane emission standards. Because there you again come to the same issues. So if you focus on it and put in delegated a clarification what you need for methane intensity standard, you could try to make this regulation predictable and workable. So there is no magical solution. We are where we are, and I think let's try to sort it out, because in other areas where EU applies similar legislation, it has worked out at the end with less controversy. But as I mentioned, this time the controversy is a bit magnitude higher compared with controversies where we have had in other areas.
Thank you very much. Tim.
Thank you, Anne-Sophie. It's good to see you and good to see you all. And hope you all had a good start to the new year and wish you the best going forward. So the discussion so far has been great. Thank you to the panelists, also in the previous panel. Listening to the discussion on methane is no surprise that the focus has overwhelmingly been on transatlantic natural gas trade, and more specifically, frankly, U.S. production, and how that can be reconciled somehow with the European regulatory ambitions. I wonder if the panel has any thoughts they'd like to share about other parts of the world where significant amounts of natural gas are produced and/or preferably also traded with the EU. We've touched on Norway very briefly. Let's leave that out of scope. I think we all believe that they'll meet that standard. But there are other parts that are relevant, and I don't think we talk about them often enough, and about willingness, interest, and/or ability to meet the regulatory standards that we talk about. So I wonder if the panel wants to say a few words about that. Thank you.
Tim,
Sure.
I'm sorry. Go ahead, Ben.
I'll be brief, but I think it's worth talking about Qatar. I mean, as I mentioned, Qatar's got basically the simplest supply chains you can imagine. They have a good story to tell, but they've really objected to extraterritorial regulation by the European Union. Most of the focus of their ire has been the Corporate Sustainability Due Diligence Directive. The CEO of Qatar Energy has criticized this on numerous occasions. They've been quieter on the EU Methane Regulation, but they haven't really been supportive. And they certainly have not put their hands up and said, yeah, we don't see this as a problem. We know we can comply. That's pretty significant. Other global gas suppliers around the world, for example, in North Africa, I see very few signs that they're ready to meet these requirements. And that's an issue. It comes back to the issue of penalties and enforcement and the risk of variable enforcement among states. What happens if everything is introduced according to existing timelines and we reach 2027 and we simply get no data from certain gas suppliers? Then it's going to be up to the states to decide what they do. Do they apply penalties? Do they do it in a uniform way? We just don't know. But I think the longer things drag on without greater clarity and more guidance, so global gas suppliers know what to expect, the worse the outcome will be, frankly.
Vanessa, I
Yeah,
think you had
yeah.
also something that you wanted to
I was
say.
good. Thank you. And I completely agree with Ben. If we think about other producing regions, yeah, I know the U.S. has a bit of a bad reputation for whatever reason in this space, but I started working on U.S. methane for Chevron in 2012, which I think is at least 10 years before the EU had a domestic methane regulation, maybe 12 years. It was a process where the regulations got better and stronger and more clear over time. But the first reporting regulation was actually passed in 2010, and the first, command and control type regulation was 2012. So there actually has been a fair amount of work done, and I think part of the reason that a lot of the angst that you're hearing is from the U.S. is because the expertise that has been developed here, there is a greater understanding of how hard it is to measure things well and how hard it is to verify, because we've tried. Through certification schemes, through companies' limited and reasonable assurances of their own reports. And so I think when that goes to countries where that maturity is not quite there, there will be greater challenges in supply. And North Africa, Central Asia, those are areas that I think will potentially be of concern. But Tim, I was going to flip your question a tiny bit and talk about how Japan and Korea, I think, had a very similar aim and ambition at the very beginning to the EU of making better methane data transparently available to buyers. And so their clean initiative, I think, does just that, right? So suppliers voluntarily report emissions data, and they can report it under a couple of different methodologies. You can assure it, you cannot assure it. If you don't have assurance available, you can report it if there's a regulatory regime. For example, Australia has a regulatory regime that has mandatory reporting with a certain protocol. So you can use that protocol, or you can use OGMP or Veritas or MIQ. I think there's a whole checklist of different options. But ultimately, they're providing data to the buyers so the buyers can make informed decisions. And the government, JOGMEC, is compiling that data and sort of serving as the in-between between the buyers and the producers. And it is also value chain based. So I think that's another thing that we should think about and look at and see how that plays out in the long run, as something that we need to keep on the table, because very similar aims, very different approaches.
No, absolutely. I mean, Europe is very, very regulatory focused, and I think Japan and Korea have a much more commercial approach, which is maybe due to the very strong links between the energy companies and the government. I mean, they talk to each other, and this has probably influenced the way that they're thinking. I mean, they could be ready to jump on the regulatory bandwagon if they see that the EU approach is working, but probably not given what we are currently seeing. And Ben, I absolutely agree with your point on Qatar. I mean, I think Qatar has a potential to basically have, platinum standard in terms of methane emission. But every time that, Tim and I have tried to engage into that discussions, like silent, absolute silent. Well, it's a shame to some extent. I saw that Mike was making a joke about the certifier or the verifier, and actually this is a pretty good question, because, I mean, what kind of companies will act as verifiers, and who certify or verify the verifiers? I mean, do we have enough people who are, trained? Because this is not easy, right? Maybe Vanessa, what's your experience?
Yeah, so I can't fully answer how many people Ernst & Young or DNV or ERM or any of those folks that do this kind of work have on staff that have methane expertise. I would venture to guess that I think it's a safe assumption that to do the EU rule at scale, going from 0 verified OGMP level 5 reports to covering the entire EU supply, there would certainly need to be growth. And I did just see the comment now that you mentioned it, that we're to accounting firms. So I mentioned some accounting firms. There are other firms that are in this space that are more environmentally focused. I know Ernst & Young verifies OGCI's climate data for our reports, so they do have a practice in this space, but there are others that are more environmentally focused. There's none that I'm aware of that have verified or are advertising a business to verify OGMP level 5 at reasonable assurance levels.
Interesting. I see that we have another question.
If I may jump in just on the verification, because there are many things that are not clear in the regulation, but at least who can do verification, I think it's quite clear. So verifiers need to be accredited by national accreditation body if they are legal entity. There is also possibility for no legal persons also doing verification, but it's slightly different rules. But I think from the thinking about methane regulation from the past, it was very clear that the Commission was against allowing just accounting companies to do verification. And in terms of verification capacity, this is concern that has been mentioned many times. But actually in June last year, we organized our OIS workshop in Brussels focusing on verification with verification companies, like real verification companies. And they told us that actually it takes roughly 2 to 3 months to train verifiers. So I would say training people is not an issue. I would say it's more what Ben said about the lack of proper protocols in order to do so. So I wouldn't say it should be. In other countries potentially there is a concern, but I wouldn't say that especially in Europe that could be a concern.
Thank you very much. I am going to go back to our IF friends and then Ira.
Yeah, thanks a lot, Ansa, and thanks a lot. Another great discussion. I wanted to try and make a connection between, the first excellent panel and this one, and to ask the views of the panelists of how the politics of this all change in a world of relatively abundant LNG. I'd like you to just sort of think through, to what extent does that change some of the dynamics that we're discussing if it turns into more of a buyer's market?
That's a good question. Thank you, Tim. In general, I think a better supplied market gives buyers more options. Maybe buyers in Northeast Asia, in Japan and South Korea and elsewhere can start to discriminate based on the emissions intensity of supplies from different providers. The Clean Initiative that Vanessa mentioned, I think, is one way to do that, because you now have about 25 companies, I think, mostly Japanese gas and power companies that have joined Clean and that are starting to get this data. And it's been shared in annual reports that JOGMEC has published. So better transparency informs buyers. I think the reality is that around the world, in the United States, but elsewhere too, it's inevitable that you'll have a mix of companies that do measurement, have invested heavily in this, provide data, are actively involved in groups like OGMP 2.0 and other voluntary initiatives, and then others that don't. And so from a regulatory standpoint, the challenge is, how do you try to reward companies that are making those investments and that have provided verifiably lower emissions gas, and also come up with incentives to try to improve performance among the rest? And that's kind of what the methane regulation was about. The question is, how do you do this without threatening security of supply? And to just return to the Energy Council meeting that happened last month in Brussels, I listened into that meeting. I heard the comments from all the member states. They were quite brief, but I heard a lot of mentions about security of supply. And I think for buyers in Northeast Asia, but also for a lot of countries in the EU, that's paramount. So at the margins, certainly it will change decision-making about individual gas suppliers. If you really have good data and have confidence in their performance, maybe it'll make you more inclined to buy gas from them. But that context of global energy security and price is really critical to keep in mind. And the EU is definitely way out in front in terms of demanding this kind of data, and it's the only regulatory requirement for it in the world. I think you'd maybe see buyers in Northeast Asia and elsewhere not follow with the firm regulatory requirement, but certainly start to request more data, press companies on it more, generate more questions if the market is looser and if they feel like they have a little bit more ability to distinguish. Hope that makes sense.
So it does. Ira.
Yeah, question for any of the panelists, but I'm particularly interested in if Vanessa has an answer to this. Do you foresee 24/7, 365 sort of dynamic monitoring as where we're going here? Are we ever going to achieve that? And if not, how close can we get to that?
I'm never going to say never, because if you had asked me 6 years ago if we could get the data that we get from an aircraft today, I probably would have said, I might have laughed at you. But, you know, I do think there are some really exciting things in the monitoring space. So right now we're very focused on what I'm calling our lagging emissions monitoring, right? Something has left the pipe and some third-party device has detected it. I think where the future is leading indicators. So we do this for operational practices all over the place, right? We have sensors on things inside pipes and inside tanks to look at temperature, to look at pressure. And those are leading indicators. So they can start to show us some sort of trend line that might result in emissions in the future. We are very focused on that right now because it gives us an opportunity to predict emissions and prevent them. But that I can see a world where that same set of sensors that is not monitoring methane emissions in the atmosphere, but monitoring for conditions that could create emissions, that's 24/7 already. It doesn't capture 100% of sources. If you get a small fugitive leak on a valve, it's probably not going to pick it up. Stuck dump valves in industry are a big problem. They're hard to monitor and they happen. So it's not going to be 100% solution, but I think if we start to change our mentality from monitoring for when emissions are outside the system to monitoring for conditions where they might be outside of the system, that almost already is 24/7 and captures a chunk of those conditions today.
Thank you.
Sure.
Just wondering whether there is another question from our different participants. If not, maybe I give to each of you the floor on, I mean, you mentioned that, 2027 is a key year and, we need to advance very fast. And I know that we have a few people here from the European Commission and the US government. So if you had a couple of recommendations on what to do over the next 6 months, what would they be in order to really advance? Maria, maybe starting with you.
Okay, just to double check if I understood correctly. So what would need to happen in order to advance with the methane regulation implementation? I would say it's mainly the responsibility of the companies. So I would say building good relationship with competent authorities. That's something that will definitely help. Again, there is this effort to harmonize and standardize as much as possible with the, let's say, network of competent authorities. This is the formal group that was established by the European Commission. So they have regular meetings with European Commission and they try to find, let's say, the balance and also the, let's say, to speak with one kind, maybe not speak with one voice, but at least to have more harmonization in their approach. One of the key topics that were discussed was, of course, traceability. That actually prepared the Energy Council decision. Another big topic on the agenda is, of course, penalties. So I would expect that there will be more clarity. So I would say to that, if I can come back just a little bit to the question on Qatar, is that, I think many people mentioned this, that Qatar is very quiet. But I think one of the reasons that I've heard from them about why they are quiet is that they have assets in the US. So that's why maybe they don't voice methane emissions that much. But on the other hand, if you look at what Qatar is doing, and even after they started to voice their concerns about the climate-related legislation back in December 2024, then in April 2025, they had a series of meetings with the high-level European Commission officials explaining that actually they see themselves as a very good supplier of gas to Europe, and they also are willing to talk about methane emissions. So I will leave you with that. Thank you.
Yes, and maybe I should add that although I haven't seen anything directly from Qatar Energy, I have seen, I think, a report from the Al Attiyah Foundation, which was specifically on methane emission. And it's a good way, because I know everything is kind of state level in Qatar, to actually convey the message while not having Qatar Energy stating something publicly. But
what could be done in the near term? 4 things: traceability, decide what's acceptable. If it's a list of 2 or 3 different things, if it's just one system, make a decision among the competent authorities, let the industry know. Endorse a verification of reporting protocol, make it clear what's going to be acceptable so that auditors have time to prepare and companies have time to work with them. Penalties. The regulation says that penalties should be quote unquote effective, proportionate, and dissuasive. They're capped at up to 20% of annual turnover. That's a really scary number. If you look at the language of the regulation, it seems quite unlikely they'll be applied at anywhere near that level. But I really think that specifying that this is not foreseeable, at least in the early years of the regulation, will be very helpful and would provide assurance to companies, to compliance officers, to law firms, and all the rest. Even if it's not binding, if it's issued in a Q&A document, that would be helpful. And then reporting deadlines, I think there is some confusion about what's due on January 1st in 2027 and what might be due in the middle of that year. There's some conflicting language in the regulation. So I'm working on a paper that cites those 4 areas specifically. There are a couple areas that we really need clarity in the next 2 quarters.
So I think the European Commission and the competent authorities have a lot of things to do. Vanessa?
Well, Ben's list was very, very comprehensive, and so I might just pull up one level and think about how we ended up where we are today, where it feels like there's maybe 2 camps throwing stones at each other, and really focus on dialogue for the clarity, so we understand each other and we try to avoid as many unintended consequences going forward as possible. I hope that the European Commission staff that is working on these rules will work hard as industry will to engage and to listen to each other and try to understand each other, so we can try to avoid unintended consequences in the clarification and the delegated acts that are to come.
Yeah, and I think the council, which happened in December, give us probably good hope that European countries are very much aware of the issue and they would act accordingly. Okay, Leslie, you are going to have the floor for the last question, and please keep it short.
Hello, everybody. I was wondering if any of you from the panel could see a scenario where Europe is actually using its regulation to gain geopolitical gains. So in the past, the US administration has floated around that some of these regulations could act as trade barriers. But do you see any scenario where right now the balance of power is not really in favor of Europe? But in the future, do you see any scenario where, because we see a lot of return of geopolitics in business and in trade, where the methane regulation can be modulated, adapted, to counter US exports?
Interesting. Maria?
Yeah, thank you for that question. I think it's really good. I think we need to remember that the proposal for the regulation was put in the public space back in 2021. At that time, majority of European imports came from Russia. So I understand that we now look at the methane regulation through what is happening today, but at least if you look at the intent, it was a completely different picture. But I think what you said about the more gas being available, that's important, I think, in the thinking of the EU policymakers and also member states. And again, there is a little bit more assurance on the European side there will be more gas. That's why I would say closer to 2030, it's not a bad time to implement that. It's never a good time to implement and a new policy providing such a big new requirements. But I think at least from European perspective, there is a little bit more assurance that there will be just more gas available. So yeah, that would be my 2 cents to reply to that.
Thank you very much. Well, ladies and gentlemen, I think we are just 3 minutes before 6 p.m. my time and noon for the majority of our American colleagues. So first of all, I would like to thank all our panelists today. So Andrew, Guillaume, Maria, Ben and Vanessa for their very helpful contribution. Also thanking my colleagues Jason and Ira first for the welcoming remark and also for moderating the first panel, and thanking all of you as well for your great participation. I hope this whole roundtable was of interest to you. I mean, usually we do have about 2 during the year. They are either fully online or hybrid or in person, and we definitely hope to have another one at some point this year, which may be hybrid. I didn't want to have one hybrid or in person in January, definitely not in Paris, because as you may have noticed, with 2 centimeters of snow, it's absolute chaos. But thank you very much. Do not also hesitate to reach out to us and to provide feedback on what you found good and maybe not so good during this roundtable. We always welcome feedback. This being said, I wish all of you, of course, a very good start of the year. It was a pleasure to see all of you, and I hope to see you, some of you at least, in person during the year. So thank you very much and have a good or evening or rest of the day. Thank you so much.